Right.
Start recording.
Yep, let's go ahead and start before we can get started. Jason, would you mind closing the door? Oh, we have to grab the door. Being on record. All right, well, thank you everyone for joining the Montana Board of Housing Training and Strategic Planning Day for Monday, October 20th. We have 5 board members here in the room and 2 board members joining virtually. So we've got all board members here. Thank you guys so much. We're going to start with introductions, and for the staff and board members who attended the National Council of State Housing Agencies NCSHA annual conference in New Orleans earlier this month. The request is to please share a takeaway or 2, something that really caught your eye or something you'd like to learn more about. Then we'll kind of keep generating a list for future board training or other opportunities. So I guess I'll go ahead and get started. So Cheryl Cohen, I'm executive director of the board, and I think my biggest takeaways from the conference were 2 sessions. One was a session on lowering the cost of development, which I think was really helpful, and there was some work that Enterprise Community Partners has done to look at the cost of low housing tax credit development compared with other just standard private market rate development. The general takeaway is that our the low housing tax credit development is on par with the cost that it is for the regular market, with some exceptions. There were a few states where the cost for development for low housing tax credits were significantly higher than most of the rest of the country. These included places like California, Washington State, primarily Seattle, Chicago, and Washington, D.C. The average cost to develop was around, I believe, $415,000 per unit, and we're proposing in our QAP, which we'll talk about this afternoon, at $399 a unit. So we think that that is appropriate for where we want to be. But there were some unit costs that were in some of those high cost cities, $800,000 to an upper end of $1.25 million. So one of the suggestions was to look at the other things that you're including in your QAP and whether or not you have provisions that are potentially adding costs. I don't think Montana's in that situation, but a lot of other states included a lot of energy and resilience type criteria, and some of those energy efficiency or resilience criteria did escalate some project costs. And we're really looking forward to seeing the report when it comes out from Enterprise. This was all provided just by a verbal update because the report isn't finalized yet, but looking at Enterprise Community Partners, and we will make that available to the board and probably include it in the packet. The other session that I attended that was really helpful was on managing and maximizing your financial resources. And so this included one of our partners, Bill with B of A Securities, and John Sean with Idaho Housing Finance Association that helped moderate. And we're going to be including a couple of the slides that they shared. The partner from CFX in his presentation will be on the Color Money presentation a little bit later, but I think that it's going to be some helpful takeaways from this stuff as well. So shall I turn it over to Vicki? Sure. All right, you didn't go to NCSHA, but you can share what fun things you were doing back at the office or other things that are on your mind or horizon that you think would be good for both staff.
Vicki Bauer, accounting and finance manager. I didn't make it to the conference this year. I would have liked to, but we had a lot going on in the office. We finished up financial statements. We're in the middle of audit, so dealing with auditors' questions. And then just with the conversion of the MDS program this year, it was just a matter of going through making sure that we had all of our files audits and checks as we go through the audit. They have processes and procedures for that conversion from higher programs to the MDS system. And then we're gear enough to do that service on December 1st. We didn't get payments and all this would be trade. So it was just a lot of money. So they stayed back.
Jessica Michael. Jessica Michael. Homeownership program manager. I did go to NCSHA. I guess the one thing that's popping up in my head is I went to the servicing breakout session, which normally I wouldn't go to, but we didn't have a servicer there, so I went because I have been working closely with servicing lately. taking time off from husband, I'm sure, semi-retirement. And I was very proud to say that our team is up and ready for the big changes that are coming for talking to borrowers and what forms have to be done if they go into foreclosure or late payments and trying to get them out of late payments. And there was a big thing happening, or it happened on October 1st with new dates. And our team is already ready, and I would say out of the room of maybe 100 people, there was only maybe 20 that stood up and said, yes, we're ready. So I was pretty proud of the team for getting that done.
Maybe Bill, you. Back in early, man, we didn't go to the conference, so. We're updates, but. Nice to meet you. Logan, welcome to the team.
Oh, okay, Joe Phillips, Operations Manager. A few of the takeaways from NCSHA I had, I got to join a lot of the IT, community folks throughout all of the jurisdictions that are part of HFAs. And a couple of the biggest takeaways from that was cybersecurity, locking down, making sure that people's data was safe, that's housed with those HFAs. So cybersecurity number one, and with us in Montana, us being administratively attached to Commerce and to the state government, a lot of software assessments have been happening now with our three softwares, which is Emphasis, HDS, and HDS is upstairs. It's the housing development software for Section 8, and so is Happy MRI. And so got to hear a lot of things about, from different vendors as well, being NIST compliance, NIST NIST, which stands for National Institute of Standards and Technologies. It's a federal regulation overarching for everyone to be compliant with. So I noticed, in talking with the cohorts, a lot of vendors are not fully compliant with NIST as of yet, but there are some takeaways from that of not being fully compliant, but where they are compliant within that kind of long document of what NIST has out there for agencies to be compliant with, and also being fed and state ramp compliant, which is part of the NIST as well too. So learned a lot from the folks there in IT, and taking back with us some of that knowledge, but also working with our IT person, Nick, and our CIO, I guess, Andrew Miller, working through those assessments for our three software components that we utilize for housing, and making sure that we're doing everything we can to make sure the security of information is there for us. So, yeah, welcome.
Hi, everyone. I'm Cheryl's executive assistant, and I did not go to the conference.
Logan did all of the logistics to help any of us going to the conference, so
Yes,
thank
yes.
you.
Where was your last?
I was a legal assistant over the summer in Missoula, and I was vice president at AFC Latin.
Jason Hanson, multi-family program manager, didn't go to the conference, so ready for tomorrow's big packet. And also went to three cities and towns on Thursday in Billings to try to get the word out with $22 million competitive loan round for next spring.
My name is Mina Chu. I'm with RBC, that's Bank of Canada Capital Markets. I'm based out of San Francisco. And I have had the pleasure and the honor of working with the Montana Board of Housing for over 30 years. I'll talk more about what Cheryl talked about, the maximizing your indenture in the next presentation with Vicki. I thought that was a really good session. And to address Joe's point about cybersecurity, last week, UniOS, which is where we put our marketing documents for, as an industry, that's the biggest hosting of OSs and POSs. That was attacked by ransomware and was shut down for 2 days. So people who expected to So now their notices, they can't really sell their bonds before it is posted publicly. So, it really does highlight, anywhere cyber attacks. And so people are getting more, not people, but organizations, are getting more, involved with cybersecurity and also insurance for cyber attacks. And it's quite scary because we rely on, technology in every aspect.
Richard Miltenberger, from Helena, Montana. And, kind of relatively new-ish board member, 6 or 8 months. And I've got to say, these kind of conferences, like the one a few weeks ago in New Orleans, you know, there's a lot of expense associated with a nice hotel, we're flying there, it's not, you know, there's nothing about it that's, you should take it lightly. It was a lot of fun there, but I've got to say, it is so worth it to me to go to this conference, to be there. And we had a meeting of other board members from other states, hearing, you know, their concerns, their issues, state by state. And then even more so, in the opportunities for networking one-on-one, which, you know, from the outside, from the public perspective, it's like, oh, that's nice. You had, you know, some bankers get together and pay for a big party for you. That must be nice, you know, but the reality is, it was a tremendous opportunity to sit by. There's a gentleman from North Carolina, who's the chairman of their board, and the guy from Louisiana, who's, I think pretty much got, Joe, your spot, kind of in Louisiana, housing authority, whatever they call it down there. Every organization has its own nomenclature. But in that hour, I felt like I picked up a real sense of the history and community of the housing movement. And, you know, I came away from the whole conference feeling that, you know, we're part of a really cool movement. And even more so, that we're very blessed in Montana. At the risk of embarrassing some of the people around the table here, you know, Cheryl, you have a great reputation. You've not been in your role that long, but everybody seems to know you and know the work that has been done by you and your great team here. And there have been some states that have had some issues where they've had, you know, they're not meeting deadlines, they're not getting the dollars out, or they're having projects that have, you know, significant issues associated with them that are not being addressed. So came away feeling like, hey, this is tremendous. I'm coming into something that's been working well, and that doesn't just happen. It happens because people work at it. So I really felt there's great benefit for me to go there and catch a glimpse of this movement nationally.
Jeanette McKee Hamilton, board member, forever, it seems. So I was struck, by Richard and Bruce were both in the same meeting, in the same hour meeting, by the fact that, the leadership there, I mean, what Garth's name is. You know, is that the housing has done really well in the big, beautiful bill, as they call it, that's how they call it. We've done nationally very well, and we've got a really good place in there. And what struck me more than that was the fact that they all want to put that very quiet under wraps. So we'll hear that. And I think you guys were there sitting there, let's don't say a word. We don't want to say how well we've done, because we are concerned that somebody might want to grab it. That was a very interesting, because I can't tell you how many different times I heard that in that particular meeting. Don't say I'm worried about what is happening with us, because it's good, but we sure don't want anybody else to know. And that just really was very interesting for me. Beyond that, really, the elevator system was so hard to figure out. It's like, I've never been to a hotel where you have to they all know. And the marketplace was so much fun, to be frank. You get your free lattes, you got the band playing through it. It was New Orleans. It was just a special time, a special moment, and a special place. But we in housing have actually really are doing what they think. Really, we got a good chunk of money and we got an escalator as well. But being quiet about it, here I am, telling you remember this. Yeah. So that was to me a struggle.
Well, good morning. I'm Bruce Posey. I'm out of Billings. I'm the board chair. The first thing that struck me was the fact that we are getting close to having a light there. So it's not there, but it's getting close. Now, how that's gonna work, they didn't get into those details. Other than they're trying to get the program started through Congress. I think that would be tremendous for us to have. To see what it looks like, but compared to the meeting last year where it was kind of a pipe dream. This year, looks that we think we're getting close, we may get this done. The second thing is when we had this meeting of all the board members, I brought up the fact that we had a group stacking credits. And no one else had that. And then the lady sitting next to me, who was from Wisconsin, a lady not relevant, said, that's what those son of a gun are doing to me. She couldn't figure out why everything's being like. If they were stacking tax credits in order to, she said, that's what they're doing, stacking credit, tax credits in order to get a better price. And so the fact that you brought it up, other people started to scratch their heads and said, that's why it's not the projects. So that was interesting. And then a little story, which I found very humorous, and it's about the hygiene of the ordinance of lack thereof. So I wanted to go to this, I've been recommended 3 or 4 different oyster places, and I wanted to go to this one, and I went out to go there. The line was 50 people deep. And it was, red tablecloth, throw the shells on the floor type, and so I said, no, so I went down the street, I looked in the window, it was an oyster house, and it had tablecloths. Well, this was nice white linen, so I walked in and they had a bar there, and said, well, I really want to sit in white linens, I usually have some oysters, so I went and sat down at the bar, got some oysters, and I kind of watched the operation. And when I was there was a round tub full of ice, and must have had 200 to 300 shark oysters. They obviously were planning a lot. Well, by the time I was done in there, they were down to a dozen or 18 oysters. They had sold them. I would obviously knew what they were doing. The guy gets a sheet. It's a cookie sheet, puts the oysters on the cookie sheet, not on ice. Puts the oysters on the cookie sheet and sets them on. Then he proceeds to scoop all the ice out of the big round tub. It's got to clean up now. Throws all the ice in the garbage can. Then in order to clean the floor, he takes a 5-gallon bucket of soapy water. He just throws it on the floor. Then he hoses the entire floor down. They haven't drained the floor. No, this is a unique way to clean the place. But then the best I saved for last. Someone else ordered half a dozen oysters, and still had 8 a week ago. So he went and got the ice out of the garbage can. And I think, man, I'm glad I sat at the bar.
Ryan Aiken, I'm a Jewish board member as well from Missoula. Fortunately, I couldn't make it to the conference. I'm teaching a constitutional law class at UM this semester. Fortunately, my teaching schedule didn't allow me to attend, but I appreciate your insights and tonight put some faces to names. Just to jump.
And the church, works in Jerry Billings and.
Sheila Rice, I know you did not attend, but is there any intro or things you'd like to share?
Sheila's on mute. Sheila, you're on mute. Trying to find a second, get you off mute.
Sorry about that. Sheila Rice, I'm from Great Falls. Good morning, everybody.
Good morning.
And Rachel?
Good morning, I'm Rachel Arthur. I am out of Great Falls as well.
And I think Megan's online.
Yep.
For an introduction. Any
Hello,
takeaways
I'm
from-
Megan Surgener. I am the operations supervisor for housing. Did you want me to share what I took away from the conference, Cheryl?
Please do, since you attended.
So my favorite session that I attended was the data and analytics. And we ended up really kind of going deep into just different modules that you can use and like AI basically, and how it's coming into business every day. It's very interesting hearing the different ends of the spectrum, that some states are not allowing it at all. And some states are like gung ho and wanting to go drive it forward. So that was really interesting. I think Montana kind of lands somewhere in the middle on the conservative side of that, but it was nice to come back and kind of make those connections with our IT people and see where we're at with that as well. And see what other people are using and the different projects that they're using it on. So yeah. Above all, networking is always really nice at those things too. So met a lot of good people and saw a lot of different perspectives. So it's always nice to open your mind and see it from somebody else's side.
Megan. Joe, can I turn it over to you for any other staff or partners?
Yep. Let's see here. Brian Barnes is on, multifamily specialist, Bruce Brenskall, multifamily, Chandler Rowling is community. Charlie Brown is on from home ownership, Danielle Bauer is on from servicing, Jesse Ennis, multifamily, Julie Flynn, community, Julie Pope, home ownership, Julius Engel, community. Let's see here. Ryan Colbert, multifamily. Looks like that's about it. Did I miss anyone else? For Montana staff? Okay.
All right, so we have an agenda and we have, approximate time placeholders. We do need to stick to the 2:30 time for the QAP this afternoon because that's a specific informal public hearing that we've invited other members of the public to join. But otherwise, as we go through the presentation today, we can be a little flexible. If anybody needs a break, just let me know. We can call breaks at different times. We have, significant time built in for a couple of these presentations. And so if you want us to be conversational, stop and ask questions along the way. And we may go down a couple of rabbit holes, even if it's not on the agenda, as we talk about, especially the history of board policies. So we're gonna turn it over to Vicki and Nina to do a color money presentation first, and then we'll take a quick morning break. Then we're gonna cover history of board policies and the evolution of our set-aside programs. We'll talk a little bit about some follow-up work from the 2023 performance audit that we had, including whether or not we would like to consider pursuing a statewide housing needs assessment. And we want to show a little bit about what we're doing, working with Builders Patch, the new software that we're using for multifamily application intake. But they have some features that we'd like to show you guys and let you know what we're doing working with them. And then we'll take a lunch. It'll be delivered around 12:30, 12:45. And then we'll talk about reverse annuity mortgages the afternoon, and then at 2:30, which does need to be specific, qualified allocation plan. Talk about our proposed calendar for 2026, and then we have a team building event this afternoon. Joe, I think I put that at 4, but is it actually at 5?
We got some flexibility with them, so I said between 4 and 5, like 4:30, and Chrissy said that was okay, so.
Okay, so we can just kind of wrap up our meeting and then, go change or drop off your things. And have work for that. So is there any questions or comments before we get started? All right, I'm gonna turn it over to Vicki and Nina.
Cheryl? Cheryl, this is Sheila. I don't know if anybody else online is having a little trouble hearing, especially the female voices. If you'd speak up and speak right into the owl microphone, there's a little bit of fading in and out going on.
Okay, we will all project and use our big room voices.
Thank you.
Is there a, Joe, is there a volume control on the owl? Can you turn that volume up at all, do you think?
It's just for us on our end for the speaker part, but when the microphone itself is, I mean, as long as you can hear me okay and people know to speak up, I think if you can hear me all right now.
Yeah.
If people in the group can speak up, then we should be good.
Okay, all right, thank you.
You can go near a speaker if you want.
Can we move the owls?
Well, because you don't wanna move them because then it'll mess up the camera view, but you can sit there if you want.
No, I can move the table towards.
Yeah, you can move the table towards it, yeah.
Yeah.
Yeah, don't move, oh wait, the projector though is gonna mess up.
Oh, yeah.
You can move your table.
We can move your table forward, Mina.
Speak loud. You can speak up on.
I can speak very loud.
There we go.
So good morning, everyone. As I mentioned, I've been working with the Montana Board of Housing for, over 30 years. And I work with, 5 different, state agencies. And, I personally, but our company RBC works with 33 state HFAs across the country. And we have a weekly call to kind of see, what's going on in the country. And I wanted to provide a little bit of context because a color of money may not sound like anything. So I think this was done by the board many years ago. The homeownership director decided to kind of segregate and try to explain to the board in colors what your resources are. So for context, I wanted to provide like some historical context. So HFAs issue bonds to do your programs, to make mortgages to first-time moderate income borrowers. But you can, when you issue bonds, you're essentially borrowing money. And my job is to find investors and try to create a bond program to really lower your cost of borrowing. And right now, you borrow for 30 years, it's about 4.5% you can borrow. You can borrow at these low rates because interest on your bonds are tax exempt. And you are currently lending at about 5 5/8 for your standard program, which is maybe about 100 basis points lower than what is available in the market. So you provide that service to borrowers. And then you can borrow at a low rate because the rates are tax exempt. And the difference between your mortgages, because you use your mortgages to pay off your bonds, that is like a 30-year annuity, a spread. Essentially, theoretically, for the 30-year life of a 30-year mortgage. But obviously, mortgagors prepay, they move, they refinance, and so the prepayments are used to call down the bonds. So the longer the mortgages stay outstanding, the better it is for state HFAs, and the higher, the more differential, the better it is. But because your issues are tax exempt, the IRS has a lot of say. It has to be a first-time home buyer. You cannot, they want you to make money, but not too much money, because that's considered arbitrage. And they set income and purchase price limits on those mortgages. So you've been issuing bonds for, you just celebrated your 50th anniversary. So over time, you issue several bonds per year, some lean years, it could be maybe only one bond issuance. And so you build equity in your indentures. And so with that equity, you can do other programs other than your bread and butter first-time home buyers. So those are the different colors that Vicki will talk about, but that's just kind of as a context. It is the equity in your indenture, is the wealth that, Cheryl and I were alluding to that was discussed in the, NCSHA, presentation. And actually, if we can go to that first page. Yeah, so this, we just borrowed this because it was kind of striking to us. So there's been a tremendous growth in the state HFA program over the past 5 years. So it shows that first bullet point, the average under 1 billion in terms of assets to more than double, over 2 billion. And a lot of that is attributed or together with the incredible growth of down payment assistance. And just to give a historical perspective on this, after the housing crash in the financial crisis of 2008, we had the Federal Reserve intervention that kept mortgage rates historically low for over 10 years. And just when the economy was starting to look up, we had the pandemic in 2020. And mortgage rates came crashing down to under 3%. When market mortgage rates are hovering around 3%, HFAs really cannot be productive in issuing 30-year bonds at low enough rates to make a substantial difference. The spread is so compressed. And that was when many of the HFAs turned significantly to down payment assistance, because the barrier to entry for a first-time home buyer was no longer lower interest rates, lower monthly payments, but it was down payment assistance. So HFA started to focus on down payment assistance as the significant way to make the more of an impact to help borrowers. And as mortgage rates started to increase in 2022, HFAs were becoming increasingly more impactful because you can make a much more of a difference when market mortgage rates are 7% and you're offering 5.5%, which was the case for most of last year. And then on top of that, you still have your down payment assistance program. And so HFAs are working like gangbusters. But unlike first mortgages that are either guaranteed by FHA, VA, or and then packaged into Ginnie Mae or Fannie Mae, DPAs, they're not guaranteed. These DPA loans, usually HFAs are on the hook for delinquencies and defaults on DPA loans, and they're seconds. So rating agencies use the worst case scenario, and generally they make us all assume that all DPA loans default on day one, and they don't really count as a part of your assets. You really do have them, but for rating agency purposes, they're saying, no, don't count that as an asset. And that's one of the reasons why a lot of the parity ratio went from 120, and this is from CFS, so it is their issuers, and I think they have about maybe about 20 or so state HFAs. So they were looking at it was kind of like a random sample of HFAs across the country. And really, there's been so much change in terms of the 2008 financial crisis and then the pandemic. It's really a way of adapting to a changing environment. So next slide, please. Okay. And speaking of rating agencies, we took this slide from the Fitch, which is the third major rating agency. And the three graphs kind of show Montana Board of Housing, and then the red line is the median of all 15 HFAs, 51. And the first adjusted debt to equity, Montana Board of Housing is not that far off. And the net interest spread, it's not that, far off from the state median or all the HFA median. But the last slide, it's a ranking, percentile ranking of, Montana Board of Housing. And that general fund balance, I just wanted to point that out, is, it is significantly low in terms of, median well, it's a ranking, so, but that's okay. The general fund, Montana Board of Housing, I think historically, a long time ago, made a conscious decision not to, build up their general fund balance, but instead keep your money in the indenture and use the indenture wealth to do other programs. And you're a nonprofit, you're not in the business of sitting on your assets, you will do other programs within it. But I just wanted to kind of show that as a comparison of where you are. Okay, and then the next slide, please. So, the next slide is more comparison, to where you are in terms of other Mountain Plain Region state HFAs. And by comparison, your bond balance, which is about 551 million or so, that is relatively smaller than your neighboring states. Not good or bad, just to point that out. And you're moving from home loans to MBSs. Whole loans are guaranteed by FHA, VA, but there's a lag. And so the rating agencies make you build up reserves for it just in case of losses and timing of those losses. Whereas mortgage-backed securities, there's really not any real estate risk that are guaranteed. Any delinquencies, defaults, delinquencies, regardless of mortgage or delinquency, these are certificates that are either paid the 20th or the 25th of every month, regardless of mortgage or delinquency. Because of that guarantee, the rating agencies, backed by the US government, so the rating agencies really don't allow or don't make you set up any reserves for them. And there are different criteria. It used to be AAA because the US government was AAA. But now, both S&P and Moody's downgraded the US government. And so most of the MBS indentures are, unless the parity level is above, I think, 107 or 109, around that range. They share the AA bond, AA plus rating.
Before you move on, why would Wyoming look out our population at first?
They are, a lot of it is, relationship with lenders. They have like a better outreach. They've also been servicing their loans, so they have a really, big understanding with their lender, whoever makes loans within the state. Sometimes states pay lenders more. And sometimes they have differing criteria, like for a while, I think like buyback policy, if the loans start defaulting or become delinquent in the first 6 months, the lenders who originated have to buy back the loans, so it's more risk for the lenders that are making the loans. So some of that is just different policies associated with that.
Also, I noticed this is from the end of March, there's to the end of June, so there was 3 more months worth of loans that happened. So it would be a little closer to the 1 million.
Right, as well as
For one,
Montana Board of Housing has always had a very conservative approach So for example, Wyoming has a, variable rate bond program. They take more risk because they issue variable rate debt. And when times were really tough in terms of rate compression, they were willing to take more risk, issue more, variable rate debt to lower their mortgage rate in comparison to other, to market rate. And so they take more risk than that, to make their mortgage rate more competitive.
So I mean, as well, the difference between Montana and all of those other states is significant, what I see in the numbers. So should Montana be wanting to ascend to the, you said it really is in, material, you said something that it doesn't really matter, I'm not sure what you said, but, I mean, Idaho is the 2 million, I'm growing my Idaho next door, 5.2. Is there something that we should be? Do you make any recommendations that builds our numbers, or does it, as you said, is it significant?
I think, one of the things that you have already done is change to a mortgage-backed security program. And so I think, their underwriting criteria, and in particular, Idaho is your master servicer. And lenders love Idaho as the master servicer because, a lot of times when servicing, they put on other, what they call overlays, on mortgages, and they say, okay, Fannie Mae allows, I'm just giving an example, I don't have the specifics, but maybe, a credit score of 620, and certain, servicers, will say, okay, they allow 620, but we're gonna do 650. Or like the whole buyback is more of an issue where they go, okay, if your borrowers start, delinquency within the first 3 months, you have to buy back the loans. And so a lot of the lenders really are, they just don't like all these overlays, that the master servicer puts in there, but Idaho is very, Idaho Housing is actually, a master servicer to, I think, 9 other state HFAs, and they've become really popular because they're not like a US bank. They understand the mission of state HFAs, and they want to keep, borrowers in their homes, and they assess their risk. So I know, changing from a whole loan to an MBS program has been very attractive to lenders, local lenders, is that correct? So we're kind of hoping that that's really gonna help build the program.
So are all of those states, without Montana, taking more risk than Montana?
I can tell you, most of those states do take more risk than Montana, with the exception of maybe New Mexico. I'm not exactly sure about South Dakota or Nebraska, but I do know all the other states have variable rate debt. And they've had, some of them, like Utah and Idaho, that number is actually a little bit deceiving because they've had an NBS program. And instead of surviving on their spread, during the heyday, they used to sell their mortgage-backed securities in an open market, which is called a TBA, or to be announced program. And they used to just sell their loans without putting it on their books. So, and that is something that Montana Board of Housing staff has started looking at as a possibility in the future, as another way of doing their program in a different way. So instead of building up your wealth of the venture, you get cash upfront. And that way you kind of diversify your income stream, and you also kind of think about if the market changes and is compressed with the rate compression, that's actually a good time to sell MBSs. Because then you just get your money upfront and people are willing to pay a premium. So because who's going to pay a 3% mortgage? That's the lock-in effect. So a lot of different issues, but I know the staff is actually looking at different options.
And is this all just single family?
Yes.
Loans?
So this doesn't take into account any family, revenue bonds. Quick fun fact on Idaho and Wyoming is, their home ownership rates in their state are about 5% higher than Montana, or 73%, whereas Montana's 68%. Just a fun fact. But I think, I can't think of any of those states that are attached to state government in the same way. So there is some differences in that our budget goes through the legislative process. Any additional FTEs or budgeted positions need to be approved by the executive branch and legislature. So we also have just a little bit less flexibility to grow our team in the way that a quasi-governmental NHA is less attached to state.
So that pretty really good, saying that our relationship is onerous beneficial.
I wouldn't necessarily say that. I think there are a lot of advantages. Joe spoke a little bit about kind of the IT perspective. We do get robust support when it comes to cybersecurity and IT. We have centralized HR, we have centralized IT, contracting and procurement is moving to centralized. So we also don't have to pay for those FTEs because we have those services provided. But we do pay for them indirectly through an indirect rate to the Department of Commerce as well as to the Department of Administration for state entities. So there are pros and cons with any way that the HFA is set up, but it is a challenge when we've identified and we have available cash to pay for a position that we don't necessarily get that position.
And I don't know if I'm correct, there is opposition, to state legislature, West Hampton's. Very small. Now, I don't know about those other states.
Bruce, you said strong opposition for what? Yeah, so one of the directions with the current administration in Gianforte's first term was for all state agencies to look at activities that we were doing and to have an internal conversation with ourselves of, are there things that we are doing as the government that are better suited for the private sector? And so we've had a lot of questions from the legislative budget committees around, well, why is Montana servicing loans? Why aren't your participating lenders servicing their loans? And, you know, we've shared that we do have still a couple of small servicers that service their own loans. With the move to MBS, we don't allow servicers to service their own loans anymore, except for the ones that are grandfathered in. But, you know, that's the direction is, you know, should we look at trying to track that servicing over time, which is one of the reasons we moved to the MBS model and our in-bulk house portfolio will contract. But we're also explaining to our elected officials that in some cases, the servicers that were servicing their own loans decided they didn't want to do that anymore and came to the Board of Housing and said, hey, can you take over our portfolio? So we acquired the Stockman portfolio, we acquired others. And a lot of it was the changes that put into place over COVID and the COVID forbearance. There were a lot of complications in servicing government insured bonds. And some of the smaller servicers or even Stockman Bank decided, you know, well, we'd like to move out of this business. And so we took lines with that. So it's, you know, more nuanced than just, okay, let's, you know, of course, that sounds like it should be done in the private sector. We're servicing government insured loans because it's a challenge to do so and others in the private sector often.
And that was certainly the case after 2008, when the housing market was really struggling with a lot of delinquencies and defaults, and the servicers were really stressed. A lot of them went out of business and a lot of them decided this is too difficult for us. So we saw a lot of turnover in servicing during the downturn after 2008.
I think this needs to be, banks have market service, it's great to do a nightmare on it. And so in order to stock price that. Get good service. Don't mark market. I not think state agents, to make market portfolios. A mark for student. 40 years of business as a student. The fact of the matter is that right. It's like if you had to mark the market portfolio, pay tax on it, the federal government. Same kind of concept.
And there are other states that take a different approach, like, I do think that Montana, the state looks at Montana Board of Housing, and if you are taking over too much of the market, they do not want Montana Board of Housing to compete with the private sector.
And this is part of our enacting legislation that's really clear that our mission is to serve those whose needs are not met by the market. Of course, that population of those who are not met by the market is exponentially larger now than it was 50 years ago. But that is the parameter that we need to still stay.
Right, whereas other states, they want you to make as many loans as possible, or they don't have that, they don't have that view. Go to the next page. So,
I just want to make sure Sheila or Rachel, did you have any questions?
I do. Mina, if you can go back to that page you were on, I just want to be sure I understand what bond balance means. That's the dollar amount of loans that we have in portfolio somewhere. From first, single family.
that's not the loan balance, it's actually the bond balance, so, that is,
It's
Yeah.
the dollar amount of the bonds we have outstanding.
yes.
Okay, got it. Thank you.
And I'll add, just since these numbers were from March, when you add in the multifamily, we did the back of the napkin map the other day, with Nathan and Drew from QTAC, as we're looking at our total bonds outstanding. And with the multifamily, we're, just a hair over $1 million bonds outstanding.
Billion.
And by bonds outstanding, we mean money that we've drawn out of those bonds, not just what's been issued, but what's been drawn to make a loan.
I'm sorry, Sheila, can you repeat that?
Right. So I think earlier you mentioned that one of the reasons that we have a lower general fund balance is because we leave the money in the bond issuance and don't draw it down until we actually need it for a loan. Maybe I'm incorrect there, but so does bond balance refer to the bonds issued or the bonds proceeds used?
It's currently outstanding, so you have, issued probably more than 2 billion worth of bonds. But every time, and then you make mortgages with it, and then every time the mortgagor prepays, refinances, or moves, whatever, we take those prepayments and we call out the bonds. So it's kind of revolving, and that 551 million is actually outstanding currently, or as of March, so it's, not how much was issued.
Okay, thank you.
And that also doesn't include the 2 bond issues we've done
Since
this
then.
year.
Yes.
So, I mean, we've been doing a lot with that NBS program. We did a bond issue in April, and we did another bond issue that we closed in August. So, there's really 50 million that's missing from this.
Right. Okay. So, we're gonna jump around a little bit, so apologize if it's a little bit confusing, but on the next page, we're just gonna talk a little bit about, this is just trying to also create some kind of context. So, we put some definitions on there, like pre-almond or pre-almond like bonds. So, we've had changes in, every time there's a tax code change, in particular that affects our bond program, this 1980 tax code change was a big doozy. Prior to 1980, we had what was, well, 1980, we had a pre-almond tax code change. HFAs used to have a lot more flexibility. You are not bound by the first time home buyer requirement. There were other arbitrage restrictions, like now the spread that we talked about, we are limited to 1 1/8. Prior to 1980, it used to be 150, which doesn't sound like a lot, but it is it makes a huge impact on what you can and cannot do. There's also something called the 10-year rule, which I know I'm getting into the minutia, but now you cannot recycle and instead of calling out bonds, you were allowed to make new mortgages with it. And this becomes really beneficial if you lock in cost of funding. If you borrow or issue bonds at an all-in rate of like 350, which was pretty common a few years ago. And now you can make mortgages at 5% and not have to rebate the government. That is a real benefit. We no longer have a lot of those flexibilities. But prior to bonds or bonds issued prior to 1980, and you can refund them over and over again. You don't have to make mortgages to first-time home buyers. And so there's a lot of different programs you can do with those bonds that you issued prior to 1980. Unfortunately, there is a life, and we have come to the end of that life, because basically they're saying, okay, you can refund, but it has to be up to 48 years. And so we have come to the end of that weighted average life, and I don't want to get into all the tax minutia. We do have some of the proceeds still remaining, but we can't refund them anymore and get that benefit. We still have some, so, yeah, no new pre-almond funds. So the next page.
Yeah.
Okay.
So as we go through.
Mina,
the presentation-
excuse me, Mina, I just want to ask a question. When we say no new pre-almond funds, I think what I heard you say is that if people have a loan and they pay it back, it loses its pre-almond designation.
So, it's not based on the loans, it's based on the bond side. So, we are actually, talking with, CSG, but really QTAC on tax law to see, we do have some pre-almond bonds outstanding, which we may be able to refund, but once again, this was the last time we did this. The rates were so low, we don't have any, why would you refund a 350 more, bonds to 450? And economically, it doesn't make any sense, but we're talking to tax council to see if there are other reasons for us to try to get that one last, and maybe it's only another couple of years where you can maybe stretch and get a little bit more juice out of these pre-almond funds. But we are pretty much capped out, because it's really only refunding bonds that were made prior to 1980, and you really don't have any more of those. It's a matter of refunding those. And it just keeps on getting smaller and smaller. And we're pretty much at that max capacity.
Okay, so let me try to state this another way. It's incorrect to say that pre-Ullman funds are repaid and sort of become a revolving loan fund for pre-Ullman programs. That's not true.
Well, it is true, but it's up, you're kind of at that, near the end of that revolving line.
And the reason that it is gonna end is that we have to pay those bondholders. I just don't know what happens to it then. What happens to pre-Ullman funds when they're paid back to us?
So we make loans with, we issued bonds, in 1980. And those were pre-Ullman, and after 1980 that are post-Ullman. But if you issued bonds, let's say 1979, and then you can refund those afterwards, and then it keeps its pre-Ullman status. But during that time, prepayments come in, and you have to call those bonds with the prepayments. And we set it up so that you don't have to, it's not a one-to-one where the loans come in and you have to prepay the bonds. We structured it, and that's that was kind of our value added. We structured the bonds so you minimize how many bonds get prepaid, but you still have to call those bonds, at least some bonds. So every year, the bonds that you issued prior to 1980 keeps getting smaller and smaller and smaller, because mortgages that were issued to with those pre-1980 proceeds call the bonds. So the original bond issuance, that amount gets smaller and smaller as time continues, because you are using mortgage prepayments to call those bonds. I don't know.
Okay, thank you. I understand. I understand. Thank you.
It still has a term on it.
Yeah.
You know, if you get a home equity loan, right, you can pay it down or reuse it, pay it down or reuse it, pay it down or reuse it, but still has a term. The term is 30 years, 20 years.
Right.
So eventually it ends.
Right. So you do have, you benefited quite a lot from your the bonds that you issued prior to the tax code change, but that is now a limited, everything is a limited resource, but it's nearing the life. Yeah.
Thank you.
Okay. Mhm.
So as we walk through this color of money, it really is to give the board an idea of the funds that are available within the indentures and what those indenture funds are made of. And so this first part, starting with the pre-Ullman, is just defining some of the terms that you hear as we go through the actual presentation. So just to give a little brief content to it. So the next definition is parity. Parity is the ratio of assets, things like cash, mortgage loans receivable, and investments, as compared to our bond debt. Parity is used by the rating agencies for credit ratings. A high parity ratio is essential to be able to pay bonds under a stressful scenario such as high delinquency rates, loan losses, negative arbitrage, high or low prepayments of mortgages, etc. And this helps, the parity helps maintain good credit rating with the indenture, on the indenture. So the single family 1 and 2 indentures, they have between 120 and 135% parity, and it gives them a credit rating of AA+ and AA1 ratings by S&P and Moody's respectively. And then the newest indenture, which is the NIBP indenture single family 11, it has a parity level of 106, and it's rated AA3 by Moody's. The next definition is set aside loans. So the board has, with the pre-Ullman money, we had established set aside programs, and initially, the set aside programs were, they were first mortgages that the board agreed to offer in combination with home program, recipients. So they offered down payment assistance products, with their home funds, and we offered a first mortgage at a lower interest rate for those borrowers. They were primarily geared towards, borrowers who had 80% of the area median income. And then there were also some special loan programs that were categorized, like HUD 184 loans. They cater to a special population of borrowers, so the board wanted to offer a set aside program specifically for that. The interest rate on the set aside loans, it's fluctuated over the years. At one time, we were like a point below the regular rate. Here recently, I can't remember exactly when the board voted on it, but the board had voted to make the set aside rate a consistent 4% below the regular rate on the bonds, or excuse me, the mortgage program. So anytime the regular rate shifts up or down, the set aside rate shifts up or down by 4% with that as well. There's a few programs that aren't necessarily considered set asides, although we refer to them as set asides. And by not being set asides, I mean that they're not 80% at area median income borrowers. So like the 80% combined program, that's a non-insured program that the board offers a first mortgage for. It gets paired with a nonprofit 20% so that the borrower doesn't need to have mortgage insurance on their loan, so it's cost savings for the borrower. That rate is actually 25 basis points above the regular program just because we don't have insurance on that loan, mortgage insurance on the loan. It's but it's still cost savings for that borrower.
It's less risky because we're on the 80% now because we're not offering the DPA.
Correct. A few other special programs that we've done over the year are like the 0%, the down payment assistance programs that we offer. So we have a 0% deferred DPA loan that is 25 basis points above the regular loan rate. And then we also have an amortizing down payment assistance loan product called the Bond Advantage. And that's a 0% above the regular rate as well. So when we talk about set asides are special programs that the board has approved, and they may cater to a lower income borrower, or it's non-insured, or just some kind of a special, there's special parameters around that program. Habitat for Humanity is another set aside. It's got a special rate of 2%. The lower rate is to acknowledge the benefit of the Habitat model, including the borrower's sweat equity in building the home, and then Habitat's role in supporting the borrower should they become delinquent. Habitat stays in close contact with those borrowers. We're able to notify the Habitat affiliate that they have a delinquent, or that there's a delinquent borrower. One of their borrowers is going, and they'll work specifically with that borrower to try to bring them current, do counseling with them, or potentially find another borrower that they can sell that home to, so that that property can continue to be a Habitat property.
Can I ask a question on that?
Yeah.
Since we're students, this Habitat across the state. Yeah.
Bruce, can you speak up a little bit?
Sure. This Habitat now across the state of Montana has standardized note fees.
When they're selling the property, or excuse me, selling the loan to the Board of Housing, we use the Fannie Mae regular note and deed of trust for, because it goes to a regular mortgage loan. The affiliates, if they're keeping that product themselves, they don't necessarily, they have their own note and deed of trust. It doesn't follow the Fannie, Freddie, or not Fannie Mae. No.
What if they want us to service those that are not standard?
We typically won't do that. We don't service non-standard. There have been a couple of portfolios where we've agreed to purchase the loans. So we don't service anything that's not owned by the Board of Housing, with the exception of the Veterans Home Loan Program, which is designated to be serviced by Montana Board of Housing. And then, Board of Investments has a small residential program, that, I don't know, has about 40 loans left in it, that we took the servicing of, from servicers that sold their portfolios to us.
But in the case of Habitat,
But
they have to have a standardized note to be the press processors.
Or it has, yes, new loans, yes. If it's a portfolio that we took over, we review the note and deed of trust and determine if there's something in there that prohibits us from servicing it or owning it, and then we won't do it.
There's
So we'll talk
Cheryl,
about
we're trying to,
Okay,
we're trying to shrink our servicing department. So we're not looking at purchasing and servicing of these loans from.
I'm understanding that, but when we take it on, it creates a profit. And we're taking it on at 2%. I mean, it's not, talk about when we get the set aside.
Yeah.
That's insane.
Can I ask a question too about that 2%? So Habitat loans are traditionally 0. So
yeah, so the Habitat model has changed a lot over the years, so, quite some time ago, they were all 0 mortgages. And for a long time, the board did fund those 0, we offered funds for those, first mortgage, 0 first mortgages. Can't remember exactly when it was, 2005, 6. It was determined that the board couldn't have 0% mortgages in their portfolio any longer. So we offered a 2% first mortgage for Habitat, and there was a wraparound structure. So the borrower would be qualified for making a certain payment each month. We would do that loan at 2%. Habitat would come in behind us, and they would offset the 2% amortization each month by writing off their portion of the loan. So if the net effect to the borrower appeared to be a 0% loan. And now really Habitat has kind of moved away from even requiring or having that 0% loan. I mean, they're catering to a little bit higher income borrowers, because even at 0% in the cost of construction, they can't do necessarily the 30 and 50% borrower AMI anymore. So they don't have a problem that their borrower is paying actually interest rate, as long as, you know, the lower interest rate.
And we are seeing other state HFAs doing Habitat loans at a significantly below rate, but not 0.
I haven't worked for Habitat for 20 years, so things can change.
Yeah, and I don't know all of the ins and outs of the programs, but as we talk to different affiliates, with those that we work with, and they've said, you know, they're not even as married to the 0% loan as they used to be. That used to be the biggest thing, right? You know, now it's just finding. Yeah.
Sheila, did you have a question?
I do, as usual. Thank you for indulging me. So I wanted to jump back to the set aside that had the non-set aside for the non-habitat CLT loans. I don't have a number on my slide, so it starts out with the special loan set aside special loan programs approved by the board. And the bottom point is that not a set aside, but 80% combined program is used for non-habitat CLT loans. Interest rate is 25 basis points above the regular loan program. I just want to dwell on that for a minute. I didn't even know we had that program, I don't think. But it's higher because it's a combined program and it includes DPA.
Sheila, my recollection is we worked with CSG at setting that rate when we moved to the MBS model. We identified that this 80% combined program could be delivered to Fannie Mae MBS. And in our contract with our master servicer, our rate for loans that are going to Fannie is lower than our reimbursement for loans going to Ginnie Mae. And so in order for the board to kind of stay cost neutral on those, we set it just that quarter point above. And I'll turn over to Vicky or Jessica if you guys have other things to add, but that was my recollection. And it was because of that lower servicing rate that we're getting through the master servicer contract.
Yeah, because the pass-through rate on a Fannie Mae loan is 75%. The pass-through rate on a Ginnie Mae is 50 basis points, so that point, we have to make up 25 basis points on the interest rate, on the Fannie Mae.
Or we're losing it.
Yeah, or, exactly. And so Sheila,
So I
we're
don't-
seeing you come in for this 80% combined from various CLT affiliates, and they're often, because it's at 80% combined, it needs that 20% community second. So we're seeing, NeighborWorks or other community partners bringing in that community second. And then we're covering that first mortgage at that point.
But that program you just described, Cheryl, is this program that these borrowers are paying 25%, 25 basis points above the regular loan program.
That is correct, and that's because of that difference in the pass-through rate that we get through master servicer, because the Ginnie Mae or the Fannie Mae rate for an MBS is a bit lower. So we kept it a little higher so we would not lose money on those loans.
Right. Okay. I'm trying to draw that comparison to the Habitat loans because we ignore that on the Habitat loans, correct?
Well, currently the Habitat loans stay in-house, so there's not a pass-through rate. I mean, we give up the interest rate, but they're funded through pre-owned funds too. They're not funded out of a regular bond issue where the non-Habitat CLT loans are funded out of regular bond proceeds.
So I understand how important it is for the board to make money on loans and stay in operation. It just troubles me that we have a CLT borrower that's paying a higher interest rate. But don't answer that right now. We'll talk about it when we get to the discussion. While we're on this part of the discussion, though, I wanted to do a full disclosure that I'm president of the Trust Montana Board, which is the statewide CLT. So obviously, Trust Montana has a strong interest in the discussion about whether or not the CLT homeowners are able to get lower interest rates. But I'll wait for the discussion. I'm just trying to clarify in my mind right now and not trying to discuss the issues.
So I think those are really the main definitions that we wanted to just point out ahead of the conversation about the color of money and funds within the indenture. If you guys have questions or if we say something else that doesn't quite make sense or something that you want to, I just let's. The Board of Housing, we have 3 trust indentures. And this slide here, it just lists the assets, the total assets within each of those bond indentures. And as you can see, the overall assets are 821.9 million. We have a large single family 1 indenture, a smaller indenture, which is a single family 2, and then the tiny indenture, which is single family 11. The next slide kind of discusses a little bit why they are sized that way. So I'm going to start with the smallest one, the NIVP indenture, which is the single family 11 indenture. It was created in 2009 after the housing crash. HFAs had a hard time issuing bonds. We couldn't issue bonds at rates that would get us any benefit in the market or give our borrowers any benefit in the market. And so Treasury stepped in and they created this new issue bond program, and they gave us the opportunity to issue, I forget what the name of the initial bonds that we, yeah, but we, chose a dollar amount of bonds that we thought we would issue that would pair with market bonds to blend down the rate in order to have an affordable mortgage rate for borrowers that would benefit borrowers. And so many HFAs created a special indenture to keep those programs segregated from their other funds. And so, for us, we did this indenture 11, and the only thing that we did was issue the NIDP bonds within that indenture. We had 4 bond issues, I believe. There's 1 bond issue left. And so that's why it's so timely. And we can't earn a lot of money in that indenture. It's just not structured for that. It was for the sole purpose was to keep our programs running during that time after the housing crash in 2008. And then,
If I can,
Yeah.
40% of that each bond issuance was bought by the federal government, Fannie Mae and Freddie and Fannie at significantly subsidized rates. So there's only 1 bond outstanding, 1 series outstanding that's still owned by Fannie and Freddie. And the rate is so low and so subsidized, it doesn't make sense for us to refund it. And we don't issue, they put so much restrictions on it, it doesn't make sense to keep on using it. Because we need to do all this reporting to Fannie and Freddie, very restrictive, so it just.
So what becomes of it then?
It'll eventually pay off. And then we can release all the assets of that indenture, maybe move it over to a different indenture to do additional.
Eventually means.
it,
10 years.
yeah, I can't remember, let's see, it was 2008 and they were 30-year. So,
We made it long in 2012. So,
oh, that's right.
yeah,
So.
Yeah.
That's the time frame.
And then, prepayments on any mortgages is gonna designate whether we get to pay those off early or not, because it just gets paid down with the mortgage payments and payoffs that we receive on those systems.
and at some point, kind of, we can take a look to see, we're paying some administrative costs, at what point, even though it's a loss, I think that, the bond rate is like 2.19 or something. So it just doesn't make any sense to refinance those. But at some point, if the administrative fee gets to be, then maybe we do just call it out.
So besides the NIDP indenture, the small one is, we call it the single family 2 indenture, the 1979 indenture. That indenture requires loans to be government insured, federally insured. So we can only do FHA, VA, RD loans within that indenture. We haven't issued in that indenture in quite some time. It used to be that we bounce back and forth between the 2 indentures to keep them both active. But because that one only will take insured mortgages, we can't have our down payment assistance loans in there because they're non-insured loans. And so we haven't issued out of that indenture in probably 6 or 7 years, ever since we started doing down payment assistance out of the bond series. So then single family 1 or the 1977 indenture is our biggest indenture, and that's the only indenture currently that we are issuing bonds out of, and that's because it allows for the government insured loans, but also conventional loans. So we're able to, because we're able to finance some of our down payment assistance out of those bond series, as we issue bonds, we need to issue out a single one, unless we were going to be able to fund down payment assistance loans out of the 1 indenture and then do first mortgages out of the 2nd indenture, and that just, it gets really complicated. So we've stuck with issuing just the single family 1 indenture of the 1977 indenture.
Why, given that you weren't born in say, I still ask the question. Why would we ever done single family?
That,
I think I can answer that.
okay.
So, the name says federally guaranteed. And at a certain point, you have been, the bond indenture, I think, was originally AA3 or AA2, and it has, the parity has grown over time, and the rating agencies have recognized it, and they've, upgraded you a couple of times. And so just having the federally guaranteed, all the loans have to be FHA, VA. The bond investors really liked it, and, they were willing to pay up for it. So you were able to get a lower interest rate on your bonds by having a very restrictive 1979 indenture. So it was a change from 77 to 79 to get your bond rates lower. It has kind of changed over time, but that was originally.
So then the types of funds, or the color of money, as we refer to it, that are within those three indentures are, the first is orange money. It's regular bond money. So we issue tax exempt bonds. We take those bond proceeds, we purchase mortgages. The assets of the regular bond programs are counted in the indenture in the parity calculations, done by the rating agencies. Those loans are subject to the IRS requirements, over the mortgage revenue bond program. So they have to be owner occupied, they have to be first time, home buyers, unless it's in a targeted area. There's income limits, there's purchase price limits, there's a business, percentage of business restriction on the amount that they can claim on their taxes. It's purchase money only, mortgages, so that we can't do any kind of a refi in that, with regular bond funds, and then there's a recapture tax provision, if the borrower doesn't stay in that home for 9 years. There's a spread restriction, like we just said, 1 1/8 spread on the loan portfolio to the bonds outstanding. And then, so those are primary restrictions on those. The next kind of funds are the pre-owned funds, and like Mina said, those assets are counted in the indenture parity calculation. The payments and the prepayments on the mortgages purchased with pre-owned bond proceeds could be used for funding set aside mortgages, or loan refinancing. We've never really done loan refinancing. I think there was only ever one time that the board had some kind of a refinancing option for their borrowers, and that was just one single deal years ago. There's a higher spread allowed, it's 1.5, but it's, like we said, it's a very limited resource of funds. The next type of funds that we talk about are Raspberry or deallocated, or you'll hear us refer to it as combined revenue. These assets, they remain in the bond series after a bond series is really matured, or all of the bonds have been reviewed or refunded. There's assets that are still outstanding, that make up the Raspberry funds. And then as those payments are recaptured by the borrower for payoffs or received from the borrowers, we can use those funds to either recycle into new mortgages, or we use them for temporary bridging. Way back when, the board used to, once you issued bonds and you used up those proceeds, you'd have to spin up a new bond deal and you would be out of money, until you actually issued the next set of bonds and receive those proceeds. Well, over time, we built up our reserves, and now we can bridge money or warehouse loans into the next series. So we don't ever run out of money. It's continuous funding. So there, we use those funds to bridge into a new bond series. We also use those funds to pay our operating expenses. So we have the spread within each and every bond series, that we fund our operations on. But what the board has always done is we've waited. Now we've gotten to the point where we have these reserves built up, and we use those funds to pay for operations. And that way, within each series, if you have higher delinquencies, you don't have to worry so much about, that's individual series not covering, its own expenses. So we use the combined revenue funds for our operating expenses, as well as from time to time, there can be some debt service shortfalls due to maybe some delinquent loans. So we didn't get the payments on these loans and we had to go through foreclosure, so we didn't get the mortgage insurance proceeds in time to pay our regular debt service scheduled payments. So we use our combined revenue funds to cover those debt service shortfalls.
Debt service means.
Debt service is our bond, semi-annual payments.
So let me ask you a question. This clarification. So we have a bond issue, I'm just gonna pick a date, we had a bond issue. Our rate is short. You refund it for 3, we get all 9. We're still, they had the trust indenture, what? So the new bond, we're only paying on is 3. Refunded and instantly bond, we get our 9% bond. That's what you're saying? We're no longer restricted by the 1 and the 8 is what I'm asking.
Oh,
yeah,
you're
yeah.
restricted.
Yeah.
They'll make you take the weighted average of the old and the new, and then compare it against your new bonds, and then you are still limited by 1 and 8. However, what we do is, we call those zeros. Basically, you, strip out some of the interest and make, the mortgages look like they're 0% loans to lower the mortgage, and then you kind of roll it over to the next series, so that, if the next series, you, need to, maybe your cost of funding is at 550 and your mortgage rate is at 550, then you use the excess revenues and you bring it over to the next deal as a subsidy. And so you hedge against like interest rate fluctuations, and, you try to make each deal 1 and 8 over time. And so that's kind of what we work with tax council and QTAC to do.
Tax loss carry.
Right, exactly.
Yeah. It's here for that one. Then the last type of funds that we have within our indentures, is the special reserve funds. And these assets aren't counted, in the parity calculation, but they're used for special programs, so they're still part of the indenture. They have the indenture restrictions on them, so that, like legislature can't come in and take those funds from us. They're still pledged to the bondholders, but they're not used by the rating agencies in the parity calculation. And we've used them for, really special programs, like we have the 0% down payment assistance, DPA program. We have a reverse annuity mortgage program created years ago in like 1989. That was funded with these special reserve funds. And then as we brought servicing in-house and we paid our lenders, for the service release premiums, we use the special reserve funds in order to pay that SRP to the lenders.
Vicky, just a quick question. You used your phrase, legislature cannot come in and take these funds. Can they come in and take other funds?
You know, I don't
It's just that
know.
you use that phrase.
Yeah,
So that,
well, because, and I use that because there was a time that they did come in and they did get money from the board. I want to say it was like 500,000, it was years ago. But then our funds, we're self-funded, and our funds really are there to support the bondholders. We need to be able to pay our bondholders, because our bonds aren't debt of the state,
yeah,
so.
it's just that,
So
that's the
there's
first time
time.
it's the only time you've said that in relation to here. And that's why I went back to say,
So,
But
so
other funds I don't,
that it's just an appropriate.
yeah,
so, there are other states, if there is a general fund that is not pledged to the bondholders, there have been state HFAs where, the state kind of, there's a budget shortfall, let's look for some money. And if there is an unencumbered state or quasi-state agencies with a large general fund balance, it has been known to be rated. But these funds are pledged to the bondholders, so they really are not, no one should touch it. Now there's release mechanisms to take funds out of the indentures in case of like emergencies, but I think it's been the board policy to kind of do their programs within the indenture for that reason.
So this goes back to the Finch reading slide at the beginning where the Board of Housing looked like our general fund balance was so much below the other rankings. And that was the unintentional decision on the board's part to keep those monies within the indenture instead of an unencumbered general fund. We also include a really detailed disclosure in the financial statements about the nature of our funds being restricted to volunteers and in the event of questions of the legislative audit committee.
Let me ask a question. We're restricted to one thing, we understand that. But we get 3/8 services, that's outside one thing. You go buy that service, what and buy that service.
That is a part of one.
That's why it's the legislative issue. Okay.
Yeah.
I understand.
And then the life of the bond, yeah, right on the regular bond, and we kind of covered this, so, as we issue bonds, we purchase mortgages from lenders, they're usually at a lower rate than the market rate. As those bonds, or excuse me, as those loans pay down, we pay our bond holders, and then at the end of that bond, we have assets left over, and those assets become the Raspberry funds that we use for operating and for special programs. With the mortgage-backed security program that we have now, it's really no different than a loan program, other than the reserves aren't required anymore. We don't have debt service reserve requirements. We don't have mortgage reserve requirements. So more of the bond proceeds can actually be used to purchase mortgage-backed securities, and we can earn a return on those as opposed to just having them invested and just earning that investment return. But again, even with the mortgage-backed security program, any payments received on those investments is used to pay the bond. Pre-element funds, they can be used, were used over the years to offer special mortgage programs. This is really just an overview of what we've already covered. The deallocated funds, we use them they can be used to purchase special mortgage loans, and they cover debt service shortfalls and fund operating expenses. Special reserve funds are for board designated programs.
Can we, sorry, go back. I just wanted to point out, the operating expenses are budget, that's 4 million a year. That is a big chunk of change. And I just wanted to point that out because 4 million is more sustainable when you have like 600 million or $1 billion worth of mortgages and bonds to sustain it. During the very difficult heyday post 2008, when rates were down, your prepayments were outpacing new production. And so when your bond balances got to be low, that 4 million started to get a little bit like you were not in danger of not being able to turn on the lights or anything like that, but it became more of a noticeable portion. And so over the past, several years, we love the fact that you're rebuilding your bond and assets. Because that 4 million is, a big chunk of change. So if you spread it out over, 30 bond issuances, it looks a lot easier or more sustainable than if you're down to like 10.
So are your operating expenses a percentage of something, so to speak, if you, what I'm saying? Not at all.
No, it really is fixed on what, the budget is, and it is what it is for staff. Rent, just everything is a part of the state, and operating budget.
So we engage in the biennial budgetary process as an executive, as being part of Commerce with the executive branch agency. So we will start looking at that in advance of the 2027 legislative session this winter and spring. And so there's a lot of different things that we do as part of that budget process. We needing to do, new computer hardware. Do we need to budget for, different software? There are some things that are outside of our control. So the state, House Bill 2, I believe it is, or the B plan bill, the state legislature is gonna vote on what a COLA increase will be for all state employees. So we have to ensure that we have sufficient funds to pay whatever the state approves for those cost increases. Same with staff employee benefits. It's part of the state of Montana package, so we don't have much control over that, any control. And then if bills are passed that, or things change where it impacts our indirect rate that we pay to the Department of Commerce or to the Department of Administration or SATSD, those things also impact, and we don't have a lot of say in how those things go down. So the state's looking to centralize IT right now, and we don't know what that will look like, but there could be some legislation in the next session around how is that new centralized IT going to be cost shared. Whereas right now we pay directly for the pay for our IT individual, but in a centralized model, it may be a different model. I think this last session or 2 sessions ago, there was another bill that had each state agency's budget, including attached boards, pay for some additional kind of data and related oversight and Department of Administration for audit oversight and other things. So if those bills are passed, then we pay a little bit more as well. So we do our best to keep our expenses and what we have control over in check, but there are things that we don't have control over, and we need to ensure that we have sufficient funds for what may be passed.
Couple of questions, does it, and need an intro. Is there a comparison, is there a comparison that is optimal or used state to state, let's say Wyoming, Montana, as far as their expenses versus ours? And does that ever come into play? Do you think, is that the?
Jen, I think that's a really good question. I know I asked questions around, for X, Y, and Z program, what is your staffing footprint for, whatever volume you're doing, whether it's, number of projects or units or loans serviced. And I want to make sure that how we're structuring our staff and our programs is not out of line with trends of other HFAs. We have a pretty small, just the Board of Housing, I think, is around 37, 38 FTE. The broader housing division is more like 65. But as a housing finance agency, we're actually relatively quite small.
Yeah, and my second, in fact, that might be interesting, I don't know, producer, not to you, but, so did the audit, that we had, was there any relevant to they looking at these kinds of operating expenses? Was that any part of the audit?
The performance audit in 2023, no, did not assess specifically around our operating expenses in compared with other states. It was really specific to our governance and our allocation.
So when we talk about cash balances within the funds that are available for use within the different pots of money that we have, combined revenue or the raspberry funds, we have 19 million of that set aside. Like Mina said, after the housing crash, with the budget of now it's 3.8. We used up some of those reserves because we weren't able to issue bonds. So we lived off the reserves for a while and it kind of spent down some of that money. So we've gotten, into the system of setting aside money for operating expenses. And then those funds, we use those for the bridging into a new bond series. We have $4 million of Raspberry funds set aside for debt service shortfalls. There's $1 million currently set aside for the Habitat allocation of funds. We gave them $3 million. We allocated a $3 million set aside for Habitat for fiscal year 26. 2 million of that is coming out of the pre-almond funds, and then 1 million that will come out of the combined revenue funds. And then, so we have 4.9 million currently available for funding special programs. Green money, there's currently $400,000 of that available. We have 3.5 million that's set aside for the RAM program, and 1.1 million set aside for the 0% EPA program. And then of the pre-almond funds, we currently have 2.5 million of that available, but that's in the single family 2 indenture. And so those loans must be federally insured. And then we included a couple of slides, potential new sources of funding, and I'll let Nina go ahead and kind of give an overview of what those look like.
So, Montana is in a very enviable position relative to your peers in that you do not have a shortage of private activity volume cap. That is another restriction. The federal government, IRS, only allows you to issue mortgage revenue bonds based on private activity bonds, which are based on per capita population. And many states have competing projects like stadium bonds or, you know, other bonds that compete for private activity cap. Montana does not. So other HFAs have issued taxable bonds to stretch that capacity, or they've issued taxable bonds for special programs, because right now we are at such a non-rate compressed environment. Even if the mortgage rates are competing against regular market rates, they can issue taxable bonds with down payment assistance, maybe for, they call it like heroes programs for first responders or for teachers, or not related to the first-time home buyer requirement. And it's kind of based on market, but other state HFAs have decided, oh, maybe we'll do some special programs with taxing. So that is on the horizon or possibility out there. Yeah. And then,
Just out of curiosity, going back one slide. Do you have examples of other HFAs, maybe in this region, that have taken advantage of this kind of taxable?
sure, Washington, for example, they do say first-time home buyer requirement, but they wanted to make it easy, so 165, I think they say anyone under 165,000 income limit statewide. And there's really no documentation necessary. When I say no documentation,
Right.
I mean, like a 3-year income limits that the IRS requires. So like Washington, for example, has a taxable bond program. It is mostly funded by the next page. To be announced, they usually sell those, but a certain portion they decided, oh, we can do a 5-point EPA program and use bond funds and use the wealth of the convention for that program. So they instead of borrowing money against it, they actually sell it And there's no cost of issuance. I talk about that spread. Well, but to issue bonds, you have to pay a cost of issuing those bonds upfront. And then you make it back and profit over time. But in TBA, it's really only the setup cost, and then, you can just sell it and get the cash upfront, and you don't really care about the prepayment rates, and you don't need private activity caps. So this is very popular for states that have a huge shortage of, private activity of capacity.
Yeah. But with this, you have to have a person or an entity that is watching the market all the time because your rate is gonna change. Right now, our rates don't change really that often, as you know. But with TBA, it would change
Every day.
daily. Every day, somebody would be hired to look and hedge what they think that rate should be for that day.
Yeah, so a capital markets function that we don't currently have, within our current activity footprint. So the question would be, is that something that we would be able to competitively hire somebody for at state of Montana wages to do that sort of capital market watch? Or would we outsource that function, which would probably be more likely? I can't remember if it's North or South Dakota, but one of them has a program, offering loans for Dakotans that had left the state but want to move back. But I'm not sure what source of funds they use for that, but that was one that I heard a little bit about. So I wanted to investigate.
Right, and then like, something about like student loans, and then moving back, because they want, it was important for certain states to get young people back into the state. So, there are different options, that other states offer.
Thank you.
And there are other, now that we're kind of talking about what other states are doing, some states have like state appropriations like Washington and California, where they create like a tax, like a county reporting tax. And they do, Washington and California have like a shared appreciation, where if they put up 20%, up to 20%, or maybe it's capped at 150, but it's a shared appreciation, and that comes from a tax that the state puts on for a program like that. And some states have a state income tax credit. And they're able to leverage for maybe, for multifamily tax credit with the developers for that. So there are certain programs that other states are doing.
But can I no longer buy a family for any reason, change forward?
For TDA.
Yeah.
Yeah, you can.
Okay, so I could say I'm gonna fill one at 5%, my market rate should be 8.
Absolutely.
We may not need a capital market for support.
Yeah, you just need like a counterparty, like, some people use like, Lakeview or Hilltop, a lot of this HFAs are using, counterparties to say. But it's a little bit tricky because sometimes they want to get into your pipeline. They want to monitor every single loan. And so some HFAs don't like that, but it's kind of, you always have that one person who lock in a rate every day based on their reservation.
But why would, okay, because I did, why would I need a counterpart?
So,
I never needed. I just did it all myself. I bought a Fannie forward, I filled it forward. I took the risk.
yes, but there's also like fallout risks. There are, there's like a market risk. When we do, when HFAs do a, like a TBA program, they either need someone in-house to like take that risk and calculate that every day, or they say, okay, we don't really want it. We'll hire, we will have a counterparty. You tell us what you're willing to buy it in 3 months. And you tell, and maybe Board of Housing makes, like a 10 basis points or whatever you want to make on each loan. quarter, whatever the case may be. And if we want to make a quarter point in 3 months, you tell us what mortgage rates we should set, every day. And there's really not, you don't need an FTE person to like monitor the capital markets for, you have, so there are two different ways of doing this. I know, Colorado does, at one point did over $1 billion. And now it's better to do bonds, so I think they did like $1 billion last year of bonds, instead of TBA. And maybe like 3 years ago, they did over $1 billion in TBA sales, so they can have a person saying, oh, it's a better execution to do bond, no, it's a better execution to sell it, and so we've got a person, they have a person doing that.
Sheila, do you have a question? I saw you come off mute.
Nope, I'm fine. Thank you.
Okay. Vicky, anything else that you want to cover? Venus?
Yeah.
All right, do we have any other questions on our colors of money and general resources, or are you guys ready to take a break?
One question.
Yes.
What I understand is we're locked into 1.5. So before we ever service loan, we gave the service of 3 acres. The land, you had to be the servicer.
Well, on a month, yes. That was the service, that was the cost of servicing, we came up on.
Okay, but that came off the one. So we were only doing 3/4. Right? So now we're doing mortgage-backed securities. That whole discussion becoming used in the past. And we get 1.5 off mortgage backs.
Right,
Yeah, go ahead.
but usually it's about 50 basis points differential, like for Ginnie Mae, you have to pay, 6 basis points for a Ginnie Mae guarantee fee and 44 basis points of servicing to the master servicer. So normally it's about 50, instead of 3/8, it's 50 basis points differential. But you get the 6 basis points into, you can incorporate that into 1.5, just the guarantee fee that you pay.
So, okay, 6 basis points, not 4.
Correct.
So we've gone from 3/4, got 3.75.
And then I think for Fannie Mae, it's actually a little bit more, right? So.
All right, well, we had a break scheduled for 10:15 to 10:30. It's just about 10:30. So how about we come back as 10:40, a 10-minute break, or you guys have 15? 10 minutes? All right, so we'll go ahead and pause the recording and we'll be back at 10:40. All right, we're just about ready to get going here in the room. We're just waiting for one more person, and then we'll get started again with our history of board policies. Sheila and Rachel, can you guys still hear us okay in the room when we're back on?
Yeah, I'm doing good with the hearing.
Yep, you're fine as long as you just speak up.
Sheila, what time is it?
1:30.
Oh,
We're gonna have fun tomorrow.
I'm impressed.
Whoa.
I'm good. I slept for a while earlier. I'll sleep during the lunch hour, so I'll be fine.
Quite the trooper. Oh, boy. All right, well, I think we'll go ahead and get started. We will have one other person trickle in the room. So this presentation, we really wanted to, we have several board members that have been with the board for a long time. And so a lot of you have a lot of institutional knowledge of the types of policies that the board has set over the years. But we also have other newer board members that don't have that institutional knowledge or history. And we've been around for 50 years now. So we thought it would be helpful to just give an overview, because I think if I were appointed to this board, I would have the question of, okay, so I'm a policy setting board. What does that mean? And what kind of policies could I consider? And so you don't know what you don't know a little bit. So we thought giving a little history of the types of policies that have been enacted, And then a bit more about the evolution of our set asides would be helpful. So let's go ahead and go to the next slide, and if I could get Jason or Richard, if you wouldn't mind grabbing the door. Thank you much. So first, we're providing a few Montana Code annotated, and Nathan, you're welcome to chime in on any of these to your heart's desire. But this is our legislative declaration. So the legislature finds and declares that there is a shortage of housing in Montana, decent, safe, and sanitary housing, which is within the financial capabilities of lower income persons and families. And then in order to alleviate the high cost of housing for these persons, the legislature believes that it is essential that additional public monies be made available for the issuance of revenue bonds to assist both private enterprise and government agencies in meeting critical housing needs. Go on to the next slide. So you're a policy setting board, so you provide policy directions for all of the board's programs. The general powers of the board are included in Montana Code Annotated 96-104, and Nathan can chime in, but when you read these, it doesn't necessarily distinguish the board, meaning the 7-member board, from the Board of Housing as an agency writ large. So when we talk about general powers of the board, my interpretation, and Nathan can jump in, but this is talking about the board as a whole, not necessarily just the 7-member board. But am I wrong, Nathan?
Yeah, I mean, the state of Montana essentially has what is a unitary executive theory, right? That all of this flows down from the governor. And that the board operates as an entity guided by the board, but board staff operates as an agent of the board, subject to board supervision, control, and operating under the board settings.
So I haven't pulled out all of the, numbered list of general powers of the board, but I've pulled out a few that I think were the most pertinent. So clearly, a power of the board is to adopt procedural and substantive rules necessary for the administration of this part of statute, including rules concerning our mortgage, construction, and temporary lending programs. We also have the power to enter into agreements or other transactions with any federal, state, or government level agency, any persons, and any domestic or foreign partnership, corporation, association, or organization. Next slide. We additionally can enter into agreements under its rules with sponsors, margors, or lending institutions for the purpose of regulating the analysis, planning, development, and management of housing developments, financed in whole or in part by the proceeds of our loans or securities and mortgage purchase programs. And we can enter into agreements or other transactions with and accept grants and the cooperation of any governmental agency in the furtherance of this part. That includes, but is not limited to, development, leasing, maintenance, operation, and financing of any housing development. Next slide. And then finally, we're required to invest any funds that are not required for immediate use, subject to any agreements with our bondholders and note holders, except all investment income from funds of the board, less the cost of investment as prescribed in law, must be deposited into our Housing Authority Enterprise Fund. I don't know why they named it a Housing Authority Enterprise Fund, because that gets very confusing with actual public housing authorities. But that's essentially the name of our Board of Housing Financial Programs Enterprise Fund. So in theory, all of our money should be within this Housing Enterprise Fund. And one of the things that Nathan and I are talking about for the next legislative session is with House Bill 924 and funds for programs that the Board of administers being at the Department of Revenue. There appears to be a conflict with this provision in Montana Code Annotated, because those are funds that we're using for programs, but they are not held within our Housing Authority Enterprise Fund. They're held within the GO Trust and the GO Housing account at the Department of Revenue. So this is a potential cleanup bill item for the 2027 legislative session. Next slide. So obviously the board has oversight over a wider range of policies. Certainly the ones that are board specific. So recently the board has developed its own meeting attendance policy. We did some work on conflict of interest policy and annual COI disclosures for each board member. We updated our ex parte communications policy. We brought the board's investment policy, to the board for review and approval, every kind of couple of years. So that will be something we'll be looking at bringing back to the board, probably within the coming year, if there's any adjustments needed. Certainly the board approves administrative rules, so this includes but not limited to the Veterans Home Loan Program. Again, this was a program that, the loans were under Board of Investments, but with House Bill 924, they are now under the Montana Board of Housing, but the funds and that revolving loan account were held with the Department of Revenue. The reverse annuity mortgage program, the board recently reviewed some proposed administrative rule changes, which are now in effect. We have the Housing Montana Fund that historically hasn't had any direct monies, but the board was involved in the administrative rulemaking for that program. Full Trust Multifamily Homes, again, the name will be changing for this program once we get through House Bill 924 rulemaking. But this was out of, I believe, House Bill 16 in 2019, and then House Bill 819 in 2020. And then the qualified allocation plan for tax credit program is also. So on the mortgage servicing side, a few years ago, the board approved a servicing policy manual. So a similar like a QAP document, but over the servicing program. We've also approved our loss draft policy. When we look to change our business model, and initially we applied to be a self-servicer with Freddie Mac, the board approved the resolution for us to proceed with that effort. The board also gave us approval to proceed with the master servicer and the MBS business model. And agreed that when we shifted to that model, the small lenders that we had in our portfolio on a going forward basis would no longer be able to service loans that they originated since they're going to our master service. Next slide. All right, lots of oversight of policies in the homeownership and servicing area. So certainly you approve all single family bond resolutions. For the single family income limits, you have the option to approve them lower than what the maximum is allowed by FHA. So we bring those to the board on an annual basis. For the reverse annuity mortgage program, to the extent that there's an exception that in administrative rules requires the board to approve that loan exception, we bring those to you. You also approve the mortgage credit certificate resolutions and fees. The board in the past has approved a co-signer policy. And obviously, all approval of our participating lenders comes to the board. The board approves any new programs or modifications to existing programs. So we had some modifications to our down payment assistance programs a number of years ago when we shifted to have one of those programs funded under the bond indenture. And then for set asides, like the Habitat for Humanity set aside that you all approved last June, I believe. When the board initially brought servicing in-house, that was also a board decision that needed to go to the board for approval. Hazard insurance policies, our deductible levels are set by. And our condo finance policy. So the limitation about the number of homes that can be financed, I believe is at 20 or 25% of the homes in a 25% condo. And that was in recognition of potential risk if we invest in more than 25% in a condo. There's just some higher risk there, you know, some contract and factor litigation laws and other issues that can be a challenge. And then service release premium levels that are paid to lenders. So I'm going to pause here and see if Vicki or Jessica or anybody else has other things to add, or if there's any questions so far on the types of policies that we bring to.
Ricky, do we have a percentage of homes in common?
Yeah.
You should.
All right.
Okay.
Bruce,
We'll have
could,
a slide.
Bruce, I'm sorry, I didn't hear that question. Bruce, can you speak up a little bit?
Yeah, we should have a policy that no more than X percentage of any condo project can be owned by one owner or entity.
But we don't deal with owner occupiers first, anymore.
No, not us. If 75% is owned by one owner, we control nothing, nor does our client. They have no say in the title. That 75% rules. So they can destroy a condo project on us in Hartman. I watched a friend have done it. So if a condo project, if one owner owns 3/4 of the project, we shouldn't be in that project.
Agreed,
So that's my question. We have a policy on it.
but they have to be owner.
But if the other 75% of the condo
Already.
is owned by one person, but we're just doing a
Oh,
loan for
The other,
the other.
the other person.
The
Sorry.
75% owner is gonna trump all.
So,
That's not where I was going, sorry.
on that, do you know what FHA and Fannie Mae's policy is? Do they have a percentage?
I think it's.
Still is with.
Yeah.
So for us to finance, we would, it has to be on the list for Fannie and FHA.
Does it still have to be for our program? And we may not care, we're not taking risk.
Right. I think it's in our terms and conditions still that it needs to be FHA.
On FHA connection.
Yeah, FHA approved or
So now
Fannie
it's
approved, so
50%.
so then if we get it 50%. And a lot
I
of times,
remember I did do a little presentation last year, I think it was, saying that there was only like 7 in the whole state that were FHA approved.
yeah, so they'll do the single unit approval in those cases. But I think a lot of times, Bruce, what happens is, as opposed to us setting policies that are on top of, we refer back to the insurers or, you know, some requirements elsewhere in the mortgage world. And we get covered, but that does require us to then know what theirs are.
Well, so if Idaho would do, be determined market. Does Idaho have such a policy? Again, we're not affected because we do not have risk, I understand.
Yeah.
But the way out, they're not gonna be insured, I think.
There's a comment from Corey Hill online. He said if we are following Fannie or FHA, then those guidelines will protect MDOH. So, but I just let you know that the comment is on that, so.
Okay.
And I think for Idaho, it's whatever Fannie and Freddie guidelines are as well. They're gonna follow Fannie and Freddie.
But I think it is important then for us, if we're adopting our policies or mirroring what the investor or insurers says, we need to make sure that we're minding any regulatory changes of that investor or insurer, and if they change their policies, make sure that we're monitoring that, and if they change in a direction that could expose us to more risk, that's.
Yeah.
Any other comments online or from board members online? Okay. So on the next page in the multifamily program, the board obviously approves multifamily bond resolutions. You make the selections of 9% tax credit allocations. All of the loan approvals, so the Cold Trust multifamily homes, the Housing Montana Fund, the multifamily loan program, and now the House Bill 924 or the co-housing program loans in the future will come to the board. Delegated inducement agreements. And then for accounting in the finance area, in the past, the board had been involved in kind of an RFP or a process for selection for our investment bank. So the senior manager and co-managers, RBC Capital Markets. It's been a long time since the board has done a competitive procurement because we're very happy with the team that we have and we seem to be working very well together. We do have right now with state of Montana government within our delegation agreement between the Department of Administration Procurement and the Department of Commerce. The selection of these types of entities for our bond processes don't have to fall under the Montana State Procurement Act. We do have some flexibility to run processes. We can still run a best practice process should we desire, but haven't been in the, it's been a long time. I don't know if you recall or if it has ever been procured during your tenure? For like RBC or?
It was 2008, yeah, is that when, you switched from UP?
I think UBS.
To RBC?
There was a time, is that the same time that there, I can't remember God's name, was wooing every single one of us board members, he was traveling around the state.
Yeah.
Meetings, taking us to
Dan,
dinner, always visiting.
Dan with.
And it was like, oh, this is.
So I'm gonna say.
It was me,
George K. Baum.
yes.
Oh.
That was correct. Yeah, but he was big in Montana, taking every single one of us out to dinner. And then after the happened. We thought, oh, with him, we're supposed to be again, yeah.
Yeah, I think it
Was that the same time?
He, yes, he went directly to the board, which was not, did not sit well with the staff.
No. Yeah, it was really.
We did, when I was in, Joe's position, when I joined the board in 2018, I think it was around 2019, 2020, we did issue a competitive process for the selection of our financial advisors, ESG, advisors. And again, that kind of fell within our delegated authority. We still did, a best practice, competitive procurement. We just didn't have to run it through the state of Montana procurement team where it has to go on the EMAX procurement site. We were able to put the proposal together, put it out on our website, notify all of the potential vendors that may be interested in responding. We reviewed those proposals as a staff and brought the recommendation back to the board for the selection of CSG as a financial advisor. All right, so here's where I want to pause because we can have some conversations around future opportunities for policy setting. So the House Bill 924 administrative rules are out for public comment now, and we have a public hearing this Wednesday at 10 o'clock. So once we receive any public comment, either verbally on that public hearing or via email, the staff will be reviewing those comments and maybe making some adjustments to the administrative rules that we proposed in response to those comments. And so if there's any changes to those rules before we proceed, or even if we don't, we're going to bring those final administrative rules back to the board for its approval. Potentially, it's probably going to be December. I don't know if we'll be able to turn it around quickly enough for the November board meeting. But really important that we have the board's approval on those rules. For future opportunities for policy setting, and I know there's several that we didn't get on this list that I'll toss out here, modifications to hazard insurance deductibles. So this is an area where we seem to be spending a lot of time in the servicing department looking at hazard insurance, and borrowers are struggling to meet our current requirements. And Jessica, could I put you on the spot for what those currently are?
$1,500. This is the premium. No, sorry, the deductible. $1,500 or 1% of the loan. Whichever is greater.
So folks are
So,
struggling to
yeah.
find, yeah.
We're dealing with first time home buyers and they buy something that's, I mean, not to be out of the realm of possibility, but surely a $300,000 house. $400,000 house. It means their deductible is $3,000 or $4,000. These people don't necessarily have $3,000 or $4,000 of course. So a lot of states are raising their deductibles to $5,000, $10,000, $15,000. So, but it's difficult for these borrowers to, they call their insurance, they call around. And a lot of them are saying, you know, this is what you're gonna pay. That goes towards their payment amount. Now the payment goes up, now you can't live in their house because their deductible.
So we've been talking with a number of other states and with Idaho. It seems that our 1,500 or 1% is lower than most other states that we're talking to. And based on the struggles of having with borrowers, it is this trade-off of should we consider allowing a higher deductible amount with the understanding that that will reduce the borrower's monthly costs. But they may struggle to then make that deductible that struggle. So that's certainly on the near-term horizon to bring back to the board.
We do allow the borrowers a 1 year, we send them a letter that's out of compliance, and we say you have 1 year to, let's say, the roof, get the roof fixed, so that you're deductible. We give borrowers a year or two to try to shop it. We don't just.
So another area would be any changes to our current or establishing new set asides. And so we did receive a request for a set aside from Trust Montana and a number of other community land trust affiliates last month, I believe, or it may have been the tail end of September. And we've responded to that request that we want to have a meeting with the CLTs involved in that request to understand more about their specific proposal, what kind of income of borrowers are they targeting? What other loan products or packaging are they proposing would be established? And so we want to have that roundtable with the CLT groups to understand a bit more how they're operating, because it seems that different CLTs are operating in a little bit different way. And we want to make sure as a staff, we have a robust understanding about their programs and approach and the nature of their request, so we can evaluate it internally before we bring it to the board. I think the other could be, obviously DPA. The slide from the color of money shows that a lot of HFAs have increased their DPA. We are funding one out of a bond issue, but we do have our DPA quite a bit lower than other states, and some of it is other states have received state appropriations for DPA, and we're not in that situation. But probably 15,000 is a bit low compared to what we see with other states, so that may be an area in the future. Certainly bringing back our investment policy. We've talked a little bit as we do have requirements within Montana Code Annotated for types of investments that we can do. But if there's interest from the board, we always want to see if there's an opportunity for us to maybe be a little more competitive or a little bit less risk averse, but still following within our guidelines as a state entity and what is prudent. Practical. One thing that we may have missed in responding to the 2023 performance audit, we did do an attendance policy, and we did a conflict of interest policy, and we did an ex parte communications policy. But I suspect one of the areas they may come back with, and they're doing kind of a peek under the hood right now to see if, what we've done to implement their recommendations. We didn't kind of memorialize our board member onboarding or training policy in a written form. So our historic practice has been that we provide these 2 training or strategic planning days in April and October each year. We've usually tried to time that April training with the thought that we will have board member appointments within that time frame. Sometimes that always worked out, and we get appointments or replacement appointments where it's not at the same cadence as a number of appointments all at once. Then what is our strategy for onboarding board members? And so like Ryan and I met because he was appointed after the legislative session, so he missed out on the April training. We recorded those trainings, so he gave those a listen. We had another meeting to just talk about, what other training would be helpful and beneficial. So I think having a written document or policy to memorialize how are we doing board member training and policy, and is there any additional things we should consider or modifications to that? One of their suggestions was in looking at the Board of Investments and their board meeting schedules. They carve out a time for like a little mini training at every board meeting. That's not something that we have done, but that's certainly something that we can discuss. I think at the staff level, we've liked having these kind of all in one day sessions. We know that it can be a little bit dry material sometimes, but it's nice to have a dedicated time to really dive into things and have conversations. Other things on the what else? Jess, do you want to chime in with brick and mortar maintaining an office requirements for participating lenders?
Where's notes, I didn't know I was talking.
Just while you're looking those up, correct, you read the administrative rules changes, is that something we do as counseling?
Yeah, so I review that, and so does Commerce Legal as well.
Okay, because way long ago, I was in the legislature, and I didn't think they meant a lot, and I realized that that was incorrect. that there was a lot of times they meant a whole bunch, and then were important things to catch. That
Yes.
at the beginning of that, I did not. No, that was just my comment. I'm happy to do them as well.
So administrative rules, 8.111.305 under approved lenders states a public or private entity applicant maintaining an office in the state authorized by law to make or participate in making new residential mortgages may apply in writing for designation as an approved lender for board programs. So my question is, what does maintaining an office mean? Does it mean you have an office with a sign on it? With a desk? And it's empty and it's locked? You're paying a lease on it, and you prove that you have a lease? Is it, you have an office in the state of Montana, and when a borrower needs you, you fly in from Connecticut, Texas, Colorado? Does it mean that you have to have staff in there Monday through Friday from 8 to 5? Does it mean that you could have Tuesday through Saturday from 9 to 2? What does maintaining an office mean? So I posed this to Brent over here, Nathan, and he went on with his legal mumbo jumbo, I'll call it. And do you wanna talk about what you think
Yeah, so
maintaining an office means? We've had a borrower or a lender that actually was part-time in Butte, part-time in Colorado. And we asked him, are you gonna be available? You know, he showed us a picture of an office with a sign on it. And we said, are you gonna be able to come? Because that's one of the things that we were passionate about, was that if a borrower wants to go in and talk about their mortgage, they should be able to go in and talk to a person that they can talk to. That was important to all of us. So, you know, are you gonna fly in when a borrower calls you? And he kind of pointed out that we do a lot with Zoom, we do a lot with online and so this is why I'm posing the question.
yeah, and so there's a couple of things to consider here. One, so when we looked at the legislative history behind this requirement, there's not a lot of detail, other than the key thing is just that Montanans ought to have the opportunity to meet with a person. Not get stuck on hold, not go through a phone tree. They ought to have an office, they ought to be able to. Now, some, lenders have pointed out that, well, this is kind of an odd, so we had to interpret that historically, both Greg and myself saying, really ought to be open Monday to Friday during regular business hours in the state of Montana. We've had some lenders say, well, if we're just across the border in Idaho and we're open, like, we're far more available to a Hamilton borrower than someone who has an office 9 to 5 in Wolf Point, Montana. So this is really, that's kind of seems to be an arbitrary requirement. Why would you disqualify us if we're an hour and a half away? If someone who is 9 hours away, but they're in state, is open 9 to 5, are they really more available than us if we have a part-time office in here? And so we've been trying to think through the policy, and ultimately the statutory intent is to have reasonable availability for someone to meet in person. So what I have advised, we can do one of two things. We can, and this goes through really the difference between an administrative rule and a policy. The board, in interpreting this requirement, could adopt a policy. Say, here's what we're gonna do. We're gonna have 9 to 5, Monday through Friday, or part-time if you have an office that's within 100 miles. Maybe you can come up with something like that that would otherwise approximate a reasonable availability in addition to this maintaining an office in state. And if you do it as a policy and somebody challenges it, it's subject to what's called de novo. Meaning a court's gonna look at it and make their own determination as to whether this is a reasonable requirement. You don't get definites. If the board goes through the Administrative Procedures Act process, does official rulemaking, we get subject to a heightened discretion. So what's called arbitrary capricious review. And unless we were patently unreasonable and made a decision that was based on no record evidence, the rule that the board adopts is going to stay. And so those are the two different approaches that we can take as a board to try to implement this policy. We need to have an office in Montana, can't get away from that. But how often, how many hours, are there any supplemental, availability options that would allow you to say part-time, but you're also closed when you're out of state, or something like that? At this point, there's been enough inquiries that I do think we're beyond just Jessica asking me and us making a judgment call, because we could get to the point that this exposes the board to liability. So I do think there needs to be, either needs to be a policy that Jessica can lean on, or go through official rulemaking and get an actual ARM in place that would be subject to heightened discretion in the event of any kind of judicial review. You know, we can have with the policy, you all get to big group, bring your own experience, talk out the various industry professionals, talk to your staff members, come up with something that makes sense. In the ARM process, there is a formal, as I think most, if not all of you know, a formal rulemaking notice and comment period. So interested parties can submit their perspectives, their thoughts, their comments, that can be used to track the rule. Ultimately, which approach we take is really up to the board, but I do think we're at the point where we have to take one of those two approaches, so that Jessica and her team aren't making these judgment calls, potentially exposing the board to risk, or to expose our liability for making an unreasonable call about what it means to maintain an office stay.
The other one that comes to mind that we'll talk about a little later is with the reverse immunity mortgage program and the maximum. So the maximum loan amount has been $150,000 for very, very long time since the program inception, I'm not sure. But we may, come back to the board with some suggestions on that loan amount. We'll talk about that later.
I'm after lunch.
Okay, so we'll have to look into that.
Stay tuned.
So I want to kind of open it up to board members online or here in the room, but are there opportunities for policy setting that have come to your mind that you want to make sure that as a staff we're tracking? Or other things that you would like to raise in this discussion?
I personally think what you have up there are very significant. To change our policy on insurance deductibles is a two-way street. We don't have first-time home buyers in the affordable rate. Now, mind you, I also understand that particularly when a town gets hit, and every roof gets replaced, the roof just builds the deductible, just the price takes with the insurance company pays and wants, so that's just the reality of it. But that's a difficult when these looked at, set aside, we're gonna talk about, that needs definitely, this whole concept about bricks and mortar. It wasn't very long ago, I was told by president, I actually ran at Icon College, that this was gonna be your new bank. But I see Stockman's open a.
Chasing got locked down, sorry.
Order. So bricks and mortar is an important issue, and it really came about, quite honestly, before we go too far, because FHA required you face-to-face interview. The board required face-to-face interview on everyone. Well, face-to-face interviews are a thing in the past, and so that's a good question, where we go with that, but I've got some very strong opinions on that, but we'll do what we talk about that. You're right, Cheryl, we have to do the board member onboarding and training policy. I do think that's what they're looking for. And we have to do that. There are important policy decisions to be made. I believe the whole industry has changed a great deal. At least since I was started in a long time ago. We need to do that.
On the maintaining an office, this did come up at the executive director roundtable in New Orleans. And nearly all of the states in the room do maintain a similar policy around brick and mortar, but there were several that don't. And the feedback was, there's a lot of online, things happening now, and why would you preclude working from those individuals? And so there have been some states that have moved away from that. But Nathan, I think in statute, we have.
We have, they have to maintain an office in Montana. Again, that's the question of, is that part-time, full-time? It doesn't even have to be open. right? You have an office in Montana, but you, you know, like, those are the kind of questions that we have to.
Well, I'm
figure out.
suggesting that that's not home office.
Right, so, right, I mean, so we have to have a, again, I think whether we do a policy or anything, but we have to have a reasonable interpretation that furthers the statutory intent of availability, which includes to some degree maintaining an office in Montana. We could not do a complete online, couldn't do it. After that, we have a lot of latitude, which would go to the board's, policymaking discretion as to what is gonna best serve Montana, so.
I saw a lease for one of our lenders, I can't remember, it was recently. And the lease was for an office space, and it was $500 a month.
Yeah.
Okay, so they make that up in one loan. And it's not even open, let's just pretend that it's closed and they're just renting the space to the desk and it's signing it.
And regarding like a home office, because some loan officers do work out of their homes, we got legal opinion from Gray that they have to have a public place where a borrower can go, and we wouldn't entertain the thought of sending them to.
And the difficulties is certainly a state like Montana, mileage and differentiation. Hamilton, let's just say, it's impossible. If you have somebody in Hamilton, obviously, but, it's very onerous. Those are kinds of discussions. It's illegal.
Yeah, legally, you have a lot of latitude to work, but what you don't have latitude to do is get rid of the maintaining a office in Montana. You have to have that. The question is, again, what does maintaining mean? And like I said, the legislative history is extraordinarily bad. It really is gonna come down to you all, getting feedback from players, bringing your own particular policy expertise and making a determination, what's gonna best serve that are trying to use this program. And, like I said, it has got to the point where it's beyond what Jessica, Vicky, and ourselves as outside counsel can sit down and make these judgment calls. It really ought to be a board call that's going to be made, because, ultimately, you guys are the policy making, entity that's been appointed to make these kind of policy statutes.
I just want to make one point on that too, having worked in real estate for the past 20 some years and having worked at a title company, the worst loans to take to the closing table are your rocket mortgages, or, you know, those ones that don't have somebody sitting at a desk. You know, it's all done by email, it's all done by, you know, maybe a phone call, but they're the hardest people to get a hold of, and that's for conventional loans. We're not talking about first-time home buyers who have a few more hoops to jump through, so, you know, whether, obviously that wasn't the intent when this, you know, rule came through, because they probably didn't exist back when this rule came through. But it's a nice little, thing to have in place when you've got, you know, people that who take advantage of somebody who's trying to get to their closing table on.
Just our timeline, are we actually going to be asked to make a decision tomorrow?
No.
So this is not.
This is all
Yeah.
discussion.
Right.
Yeah, preliminary, put the thought in head.
And so on, before I move to the next slide, on number 2, so changes to current or establishing. So, you know, the staff has, you know, received things like the Habitat for Humanity set aside and brought it to the board. We received this new CLT set aside request. We'll evaluate that and bring it to the board. But board members are also able to suggest things to us. So if a board member feels really strongly about a certain type of program or offering, you know, maybe you like the idea of, you know, what one of the Dakotas is doing with providing, you know, favorable financing for young Dakotans who kind of leave their state and want to come back and be left at home. Or, you know, providing financing for, you know, teachers, firefighters, police, you know, kind of the first responders, essential workforce. So just because the staff has been bringing these things, there is nothing preventing the board members themselves from engaging staff to say, I'd really like us to focus on this area. That doesn't mean that we're gonna have the available funds to do it. That doesn't mean that we're gonna have the staff capacity to take on everything all at once, but we do want to hear from you if there is a particular interest or an area where you think that we're not meeting our legislative intent and that you see a gap. That's where we want to hear. All right, next slide. So, historical set aside process, and Vicki do chime in on any of this, but prior to 2011, we maintained kind of an open request for proposals process from local governments, nonprofit, for-profit entities with experience in housing, and organizations would submit a request for an allocation. The board staff then managed a list of these approved set asides, and as Vicki mentioned in the Color of Money training, a significant driver of the original set asides that were established were to provide matching funds for the Home Investment Partnerships program. So this is a federal program. It's under the HUD Community Planning and Development umbrella. The state of Montana receives about $3 million in its home allocation per year. We do have a couple of participating jurisdictions, I believe the city of Missoula, Billings, Bozeman, yeah, receive their own home allocation. And so one of the eligible uses of home is to provide down payment assistance for eligible home buyers, but it does require a match. So that was a big reason for setting up a lot of these initial set asides. But the administrative management of growing list of these set asides was becoming burdensome, administratively burdensome. And so the staff moved to a kind of a set aside pool for pre-existing items. But as our pre-omen funds wind down, the board is only able to use a portion of the available funds for set aside. So in the Color of Money, we talked about the $3 million habitat set aside. We had $1 million available in pre-omen, so the other two were coming up. Okay, 1 million, 2 million.
Yeah.
All right.
Cheryl, I had
See,
a question.
Go ahead, Sheila.
Administrative management was burdensome, so the board staff moved to a set aside pool for pre-existing lenders. That doesn't mean that you can't offer new set asides. It just means that they're not broken out by the individual participating organization. It's a pool.
Yes, that is correct.
Okay, thank you.
Vicki, anything to add here?
Got it.
All right, next slide. All right, so most of the set aside loans are now currently funded out of the regular bond funds. And as we discussed earlier, the interest rate, except for the habitat loans, is that quarter point below the regular bond rate, 5.625. With the exception being Habitat for Humanity, funded partially by pre-occupation. Next slide. So here's a list of the current set asides as they're listed on our website, and there may be one or two others. So you can see that Match for Home program, City of Missoula, Bozeman, Billings, Naval Works. HUD Section 184 is more of a special population loan program. Some of these others were very small and particular to a specific development. So I think the Montana Street Homes, that's like 6 homes, right?
Yeah.
So
And I didn't qualify for Fannie Mae or FHA financing because they're FEMA trailers that were put on permanent foundation. So they're not manufactured homes, they're not stick built homes. So getting them approved with one of the other insurers or mortgage offers wasn't possible. So the board took on that project specifically so in perpetuity, unless a bank finances a mortgage and pulls it in their portfolio, the board will be exempt.
And so the common theme is really looking at set asides. It's, supporting with match funding to leverage other available resources, special population programs, or homes or borrowers that couldn't be financed by other means. And so we really want to be careful in establishing new set asides to think through, is this a program that can be financed through one of our other vehicles already before we set up a new program or a new financing instrument. Next slide. So here's just some questions for board consideration when we look at set aside requests in the future. So I just covered this one, but meeting the needs of borrowers that are unable to be served by other board or conventional financing programs. So to date, this has included the Habitat for Humanity at 2%. And that's, and like the Montana Street Homes, similar. And we also need to consider now our new master servicer relationship and the opportunity to pool set aside loans for delivery to Ginnie Mae or Fannie or Freddie. So again, the pass-through rate. So if we offer a 2% set aside, the board's interest earnings would be 75 basis points less than the note rate on the loan if it's delivered to Fannie, and it would be 50 basis points less if delivered to Ginnie. So the other aspect of this new business model is the goal of reducing our in-house servicing portfolio over time. So would we want to establish a new program that could be pooled for GSE or Ginnie Mae delivery and then be serviced by Idaho Household Finance Association? Or would we be comfortable with setting up a program that would need to be serviced in-house? So I think those are some really fundamental questions for board members. Excellent. So obviously we have limited agency funds, and there's always an opportunity cost. So if as a board, we decide we want to do X, then we not have funds to do Y. So we always want to think through those trade-offs. And then the staffing capacity, and our capacity as a team, is limited. So we've got a lot of activities underway right now. We're working to implement, all of the new House Bill 924 program, which has 3 sub-programs within it. We've already done a MOU with BOI. We're going to do a MOU with Department of Revenue. We've had to take on new account reconciliation activities. We'll have to set up new application intake and staff review and ranking processes, which will be different than the low housing tax credit program. So there's a lot happening with that legislation. Changes in executive leadership, this will be covered in tomorrow's meeting, but Mary Popovich departed the board on October 3rd. And so we are recruiting for a mortgage servicing programs manager. We have 4 interviews scheduled over the next couple of weeks. But it's been a challenge with Vicki moving from homeownership over to accounting, and then Jessica coming in, and Vicki helping to train Jessica. And so we have, with just 37 FTE, when we have one loss in an executive leadership level, it can be quite impactful, and not just for that business unit, but impactful for the rest of the executive leadership team, as we need to roll up our sleeves and do everything we can to support that transition. Addressing prior audit recommendations pertaining to our information systems, amongst other things. It is a good deal of time for staff to address and move to resolve prior audit recommendations. And honestly, that's a very high priority, because we don't want to get the same audit recommendations multiple years in a row.
Is there any indication of another audit coming forward?
We're in our financial compliance audit right now. So, yeah, we have 3 audits underway right now. We have the annual Board of Housing financial statements audits, and this is the compliance year for that. It's a compliance audit every other year. Outside of the Board of Housing, we have the Commerce single audit over our rental assistance programs. That audit has been ongoing since January, February of this year, and has not been completed yet. So we're on month 10. And then we have the performance audit, which is a smaller, like up to 150 hours, where they're just reviewing what we've done since that audit. So even if we're not just looking at, Board of Housing staff capacity, but positions like Joe and I, we're split between the Board of Housing and the broader housing division. So it's not just, I'm working with Vicki on the Board of Housing's financial audit. I'm helping the rental assistance team on their 10 months now of audits and the performance audit. So I just want, we appreciate the board members' understanding when we have, reduced capacity, because we need to be very responsive to auditors and get things resolved. And then we still have some continued implementation of our MBS and master service. So we talked a little bit about, the 44% and that 375 SRP. We still have some assessments that we need to do in looking at this new model. How much money are we making? Is it comparable to what we were making before? Is it a little bit more? And how to model that out? So that's really important for us. And Vicky gave an overview recently with one of our auditors on, you know, how is our oversight with Idaho Housing Finance Association and their process for pooling loans to NPS? How do we ensure that they haven't missed one of our loans? And maybe there's just one hanging out there that they never got. So there's a lot of work in thinking through what's the appropriate level of oversight and how do we document all of these controls that we're still continuing. Anything anybody wants to add? Else? Okay,
I believe there exists a conflict between us providing housing for Montana as put in statute and a set-aside program that does not allow everyone to participate and still all taxpayers. And so to say, well, we're gonna give you a benefit, but you can't have it. I just don't think that's right. On the other hand, we need to provide what we can do for housing for the state of Montana. So this whole set-aside program is not insignificant from my standpoint. There is a level we have to be at. No set-asides, I could argue that's a good thing. Bunch of set-asides, I could argue that's a good thing. But that's why this is important, the discussion to have. We had a little bit of a discussion about habitat. We don't know what habitat does now. But we have a set-aside. I personally think that makes no sense. We ought to know what those people do if we're gonna have a set-aside. What are their rules? What are their regulations? How are they doing? So this whole set-aside thing is something we need to think about and think about seriously. Who should or should not have it, if anybody should. So I think this would be a fine discussion to have.
yeah, I completely agree. And in addition to meeting a roundtable for the Community Land Trust, we are also looking to have another roundtable with the Habitat affiliates, because they all do operate just a little slightly differently. And sometimes we get loans in, you know, where, you know, Jessica's team has the NBOH loan, and maybe Julie Flynn in Community Housing is providing the home DPA. And there's, you know, everyone we're working with, to their credit, is trying to be creative, come up with creative solutions. And sometimes creative solutions are something that we haven't seen before. And so we want to make sure we understand what's happening with the different organizations, so we can absorb and either say, wow, that's a great idea and let's run with that. Or we can say, well, this was a creative solution and we commend you for that, but this is not gonna work with, you know, regulatory compliance for the federal government. So those are really good discussions to have. And I think the other one in set-asides is the public benefit. So I suspect Sheila may argue that for a CLT, you know, the public benefit is that land and that home on that land being available, you know, permanently or in perpetuity, versus doing an individual mortgage loan where maybe the borrower will live there for 7-8 years and then refinance. So it's the, you know, who are we serving? Who gets to access a set-aside rate that's lower than a regular bond rate? What is our rationale for that? Does it make sense? And what is the public benefit?
Do we ever collaborate or exchange information?
Other states within the state of Montana or other, other housing finance agencies?
Boards within the state, so I'm thinking like, for example, Board of Crime Control, I could see. We could have policies relating to housing that might synergize with policies for the Board of Crime Control, or something like that. Is there any of that sort of interaction with other boards, Jim?
I wouldn't say with boards, with other state agencies, yes. I can't think of a specific example for the Board of Housing other than the prior arrangement with the Board of Investments and the full trust. But for the broader housing division, one example would be in our Public Housing Authority administrative plan. We worked with Department of Justice and the Montana Treatment Courts to add preference for up to 75 households or individuals that are in active good standing with Montana Treatment Court, meaning that their name kind of rises to the top of the wait list for voucher issuance. And the rationale that we had in establishing that preference was we wanted to acknowledge that people that are working to move forward with their lives and address things in their past that have been a barrier in their life to help with family reunification and, you know, obviously when people have stable housing, recidivism is decreased. And so I think it's really important to have those kinds of conversations. Sheila?
No, I think buried in this set of questions, but I want to make it obvious, and Bruce alluded to this as well, is the issue of how can we serve a lower income home buyer? And I think today's market, as we all know, it's just really, really difficult. So if we can have some protection built into our loan program, like Habitat and the CLTs do, they have constant communication. I speak directly for the CLTs every single month. They know whether or not that buyer made their mortgage. They're backstopping them. And in the 2008 mortgage crisis, the CLT loan foreclosure was 1/10 of the average across the nation. So we know it's a proven model to have a safer loan. But I just wanted to call out here that we really, my emphasis is to how do we serve a lower income buyer and how do we create permanent affordability in homes? When I was the director of NeighborWorks, we probably built 300 homes. And to my dismay today, not one of those homes is a CLT home. If they were, we'd have 300 permanently affordable houses in Great Falls, Montana. What a wonderful benefit that would be for the next generation and the next generation and the next generation. So those are 2 points I just wanted to make. Being able to serve lower income borrowers and being able to create permanently affordable homeownership. Now I want to move to a couple questions that are directly related to these questions. And I'm really understand, and I am always in awe of how much the board and the housing division staff take on and get done right. I mean, it's awesome how well everyone performs. Even to the point of this discussion, of this presentation today, you know, my thanks goes to Cheryl and her staff and Nina and her staff for putting this together because it's packed with such good information. So thank you for that. My question directly though is when we talk about adding another program, would it be easier to add another program to the existing pool of the 0.25 set aside than it would be to make the Habitat pool bigger by saying Habitat/CLT?
It's a good question, Sheila. I think it will come down ultimately to availability of funds. And what flexibility we have with, you know, funds that we have, especially with the pre-omen winding down. So if, you know, we did a combined Habitat CLT set aside at a 2% rate, and the total set aside was maybe 4 million, you know, we would need to look at our availability of funds. Now, if it became combined and the total for both was, you know, 6 or 8 million, that may be less feasible. So I think there are certainly a number of commonalities I see between the CLT model and Habitat, as far as their engagement with the borrower and the availability of the CLT to be there, should the borrower become delinquent. So I think those were things we've completed through, and my hope is that we'll have kind of a CLT roundtable within the next, you know, month and a half, and then have another convening with the Habitat folks as well. And maybe we can try as a staff to tease out, you know, where are these the same and where are these different? And does it make sense to have them be, you know, a completely separate set aside, or would it make sense to have it on set aside? But I think we need to
So
learn more about.
Cheryl, right. Cheryl, let me ask the question again. I'm not talking about the funding availability. I'm talking about the staff involvement. Would it be easier to expand the 0.25 discount pool than it would be to create a Habitat/CLT pool? I'm just talking about staff right now because a lot of the earlier discussion was related to the intensity of the staff workload right now.
Yeah, I think I'd have to give it some thought. I mean, we have separate terms and conditions for the Habitat program than, you know, other programs. And so each time you have a kind of special type of program, if you need to have special loan terms and conditions around that program, then that's another set that we need to do and maintain and update as a staff. If it involves another, you know, checklist for the loan file and training staff on the different things they need to look for in the loan file, that can add elements, but we would want to make sure that if there are substantive differences that necessitate them being separate, then yes, that would impact staff.
Okay, so I think that would be a question worthy of considering among the staff. Because if we're not talking about money, and I understand money available was very, very clear in the prior slides. But the point is, how can we make this easier on the staff? What's the best way to make it easier on the staff at the same time meet the needs of the lower income borrower? I don't want an answer to that now. I just think that's worthy of staff consideration of like, what's the more complicated way to do this? And what's the least complicated way to do this?
Thank you for raising that, Sheila. I completely agree. So we can pocket that question as a team, as we look through this going forward. But your first question kind of queued up, and if we can go to the next slide, you talked about set asides and how can we serve lower income home buyers. And that was, you know, precisely the impetus for setting up some of these in the first place, was really helping folks at that 80% of median or even deeper affordability levels. And I think we all are passionate around homeownership and wanting to help as many borrowers enter into homeownership as makes sense for them. I would caution, just from my experience in Seattle, where sometimes I saw an effort to assist, you know, very low income home buyers, where they end up with, you know, a first, a second, a third, and something else. And at some point, I think in Seattle, there started to be the question of, are we setting up these borrowers to fail? Is the price and the cost of housing just beyond the reach of a low income borrower? And, you know, where do you kind of cut the line there? So I think that's, you know, something for consideration. Some of the other things for set aside requests is, you know, are we talking about new construction or existing homes? And, you know, if you're taking an existing home and moving it into a CLT, you know, that may be more straightforward than new construction. You know, how are the purchase prices set in these programs between Habitat and community land trusts? And that there may be some nuances there that we want to explore with those agencies. Would the borrowers under the set aside program also qualify or access more DPA loans? And so we want to think about the extent of funds that we have available there. Are they for specific property types that can't be pulled or delivered to Ginnie Mae or FHA, or Ginnie Mae or Fannie Mae? The distressed properties program had 184. And then are we establishing set asides that can leverage or be paired with other federal programs? So kind of the big for our buck home program, but also meet the stabilization. Next slide. And there we go. So I think we're doing pretty good on time. Questions, comments, team, did I miss things that you want to add?
When it comes to the community land trust, putting land into this trust in perpetuity, I have a great deal of experience with the conservation area as well in putting land in perpetuity. I will tell you that there is a fair amount of opposition in this state to putting land in perpetuity. I personally think it works. And I personally don't think perpetuity is a legal term, because if we need it for something else, we'll use it. But I would tell you that we do a conservation easements done by Fish, Wildlife and Parks or by anybody else. And it's in perpetuity you've taken that land out of any opportunity in the future. There's opposition to that concept. I understand the opposition. And there are those who have done that who have regretted it. Saying, man, now I wish I could have done this, but I can't. Particularly maybe somewhere where the Bakken may have been involved, but you can't really. Because you said you wouldn't. So just an example. So I think when we get into this entire issue as well, and dealing with taking something and say, this is it for its history. Understand that we may get backlash from that. From a legislative standpoint, from a public standpoint, that, no, we just don't believe in it. I just had this discussion at this Ducks Unlimited, 'cause I was speaking with their conservation staff, and the land board still has problems in the state of Montana for perpetuity. So it's just another thing to think about. Oh, it's great. Well, maybe it is, maybe it isn't. Conceptually, it may be. Everything we do, every time you do something feel good, there's a negative to it. And we need to balance the feel good against the negative.
Explain the opposition to me, get more detail.
So if I do something for perpetuity, I can never use that land.
Well, I understand that, but I'm not on the who you think the opposition is.
I know it's Montana level.
Okay, I live in Hamilton, Montana, and we have a land trust. Hamilton, Montana is, we are very conservative in that arena. So when the bond issue was put up for a low town there, it went forward with a 76% positive from all of that conservative entity.
I understand.
And so it's taken a lot of land and ranches aside.
And the land board has nothing to do with that. But I'm telling you, the land board, when they do have something. That which is a state, which is a board consisting of 5 state officials. Governor and commissioners, that's correct. They are opposed to perpetuity. So it is a political issue.
Political, that's exactly what you said, yes, that is true.
So I just bring it up. Those are all considerations to have, because what seems to be a no-brainer, it's not always a no-brainer for other people.
Bruce, this is Sheila, and I'd ask this of you and Jeanette. Have you heard, I understand what conservation land trusts do have opposition, but I have yet to hear anyone or any complaints about community home ownership land trust homes. It's just, they have some shared verbiage, but they're such different animals. So have you heard
Yeah.
something specific to land trust homes?
No, I'm just anticipating it. That's,
Okay.
I'm just there. We have to anticipate what may take place. That's all. I've not heard a word.
Thank you. Thank you.
And I'm looking at our CLT terms and conditions right now, and we reference a lease based on the National Community Land Trust Network. And then it cannot exceed 75 years. Does that go back to a state of Montana law? That was my
Yeah,
understanding. It is
the
a limitation within state law. Go ahead, Sheila.
the 75 years is state law. And really it's in perpetuity because it's so rare that anyone would own a home for 75 years. So when that home sells to another CLT buyer, that 75 years starts ticking again.
Gotcha. Okay. Very helpful. Well, before we move on from this, is there any other questions about kind of the history of policy setting for the board, history of our set asides? Anything you guys want to ask?
Well, Bruce did say earlier that he could argue for lots of set-asides or some set-asides, and he could also argue against them. And I feel the same way. It would be easier. Life would be easier if we had no set-asides. But we would be different. We would be a different board. We would have a different program if we didn't recognize our ability to help lower income home buyers. I'm very sensitive to Cheryl's comment about, are we setting home buyers up for failure? And there is no evidence of that in the land trust movement. Thousands of homes across the nation somewhere around 400 in Montana. We just haven't seen that. We haven't seen anybody get set up. Very low foreclosure rates, which would indicate that they were set up for failure. And one of the reasons that that works is that the land trust staff spends so much time with the home buyer before they even become homeowners. Even to the point where the land trust pays for a separate lawyer that represents that buyer to go through every document that's included in the land trust materials, because they want to be sure, the land trust want to be absolutely positive that the home buyer understands what they are doing. They're giving up some of their equity in exchange for the ability to become a homeowner. And the shorthand that I use for that is, if you can buy a house in any other way, do not buy a land trust home. But if a land trust home is the only way you can buy a house, then it will be your first step to owning a market rate in 5 or 10 or 15 years. So just wanted to get that out there, that we don't want to, I personally don't want to give up our ability to help not just Habitat, not just Community Land Trust, but other home buyers who just need that little tiny bit of more help. We think, 0.25 isn't that much. It can be the difference between buying and not buying for a certain income. So I urge the board in our further discussions of this and the proposal that will come from whoever brings proposals, including Trust Montana and the statewide and the other CLTs, to just say to ourselves, who do we most want to serve here? Is this a way that we can serve buyers who otherwise would not be able to become homeowners, but deserve it in every other single way?
Excellent, Sheila, and yeah, I certainly agree. My comment in reference to Seattle wasn't specific to homeowners in a CLT model, but just the general philosophy of, when home purchase prices get over, $500,000, $600,000, $700,000, where's the comfort level and what level of assistance? So it wasn't specific to those in CLT, and I'm really glad you shared the statistics around borrowers and delinquent history for CLTs. That's really helpful information. All right, if folks are okay, just kind of plowing through before we take a lunch. Okay.
Cheryl, I have
so I'm
just
gonna-
one more, Cheryl, I just have one more quick comment. And one of the ways the CLT works is that it brings the cost of the housing down because the
Yes.
land is not included. So I just want to make that comment and kind of counterbalance that as housing prices continue to rise, this is a way to keep housing prices down and affordable. And that is the last word I'm saying on this discussion, I promise, and we can go on to the next part.
Until the next time, Sheila. All right. So we're gonna pivot a little bit, and I'm gonna have Logan bring up a website called Builders Patch Housing Count. And before I dive in, and I know this is New York and not Montana, and obviously we're not New York, but there's a reason why. So if board members recall, during the 2023 performance audit, one of the recommendations was around, is the board doing its utmost to ensure that the low-income housing tax credit projects selected are meeting the needs of the lowest income renters in Montana and where those needs are the most acute. And one of the recommendations was, should the board consider procuring a statewide housing needs assessment with that level of data to help inform future board decision making on where low housing tax credit allocations are moving. Jason's done a bit of work chatting with Vicki and her staff. We do have some funds that come in through our tax credit process and compliance inspection fees. And it sounds like we could have some money to fund a statewide housing needs assessment. We've heard from other states, and Jason chime in, but in the couple $100,000 range, is that about?
100 to 300 depending on how we get.
So we can look at, and we've been following several community threads on the NCSHA website of other states that have undertaken statewide housing needs assessments, what vendors they used, did they feel that their collaboration with the vendor was strong? And in your board packet agenda, for this agenda item, I've included links to several statewide housing needs assessments, that have been completed in the recent several years, including Illinois. And with Illinois, I included a link for they had regional profiles as well, which I thought was fairly helpful. Florida did, a 2025 rental market study. And then they did a specific assessment for housing for persons with special needs and homeless populations. So that was kind of an interesting take rather than just statewide needs assessment, but they kind of honed in on a couple populations. Kansas has undertaken a statewide housing needs assessment, and then Wyoming as recently as last year undertook a statewide housing needs assessment. So when we responded to the performance audit, we talked a little bit about, the shelf life of such an assessment. Is it really the best vehicle to use to rely for decision-making of future LIHTC allocations, given the time-limited shelf life of such an assessment? But setting aside that from the audit recommendation, there seems to be a benefit for a statewide needs assessment for general information sharing, communication with our elected officials and partners. And so we just wanted to bring this back to the board of, is this something that you would be interested in us pursuing, a statewide housing needs assessment? I think we do have the funds available to do it. We could do it one time and kind of see what the results are and what we like. I don't know if we want to sign up ourselves for having to rely on doing a statewide needs assessment, with a great deal of frequency. We may not have that level of funding available. But just wanted to bring that up. And so I'm going to pause there and share another aspect of this, and then we'll open it up for conversation. So the other thing that we're working on, and in the board packet for tomorrow, you'll see, the population change in counties, where we funded for 9% tax credit projects in history. So a lot of different data to help inform your decision-making on where is that housing needed the most. And of course, we feel like, well, it's needed everywhere, but maybe it really is needed more in some areas than others. So Builders Patch is the system that we brought on for the tax credit and our multifamily loan programs. And they've been working on this feature called Housing Patch. And this is an example of what they've built out for the state of New York. And Logan, if you just scroll down a little bit, you'll see these kind of helpful categories. So it's a county by county breakdown of their renter population, the extremely low income and very low income households in that county, the percent of households in the county that are rent burdened, meaning they're paying more than 30% of their housing costs. And then you want to move Sheila's little icon slightly out of the way. They have this supply and demand ratio where they're doing an assessment of the shortage of affordable housing units in that county. So the underlying data behind this is American Community Surveys data, which obviously we have access to. And Builders Patch as well. And we've had a number of calls with Builders Patch and also with Ben Gill, who's an economist with the Commerce Research and Information Services, of could we build this out for Montana and provide this as a resource, not only to board members to help inform decision-making, but also to developers who are looking and thinking about where should I propose my next project. And I liked this presentation because it was fairly simple. When you bring in data and statistics, it can get real complicated real fast. But I liked it at the county level, and I liked in particular that shortage of units. So where we're at with Builders Patch now is they're going to work on building out this information using the same sort of American Community Surveys data as what you're seeing here for the state of New York. And then Ben Gill and the Commerce Research and Information Services team has been in conversation with a couple of private market companies that we may be able to procure. I think one source is free, we already receive, and another we would need to pay for, but like real-time rental listing data. So the American Community Surveys data is always going to have a lag time, 2-year lag time approximate. But the data sources that we're looking into, we'd like to see if we can get a robust data source for real-time asking rents in Montana to further augment this data set because that ACS data, especially for Montana rural communities, the sampling sizes aren't that great, so sometimes the reliability of the data is like. So right now Ben's working to see if we can bring on that extra data source, for that real-time asking rent, and then we can build that in with the builder's patch data to provide. So those are the kind of two for approaches that we've taken, and kind of looking back at that 2023 performance audit, how we responded then, and kind of what we've been thinking about since then. And so I'd love to hear from board, would this be helpful? And is this something you want us to pursue? And then additionally, would a statewide housing needs assessment still us?
Since I was involved in that whole audit, there's two sides to this issue. When we argued against it, the argument was, I don't care if you're 80% or 30%, if you're homeless, you need a house. And so the statewide assessment did nothing for us. It was a waste of money, and it was a one-time look at it. A year from now, it's totally different. So I can understand it. You can argue the fact that, okay, we have a statewide assessment, we do have something to talk about. We can talk about it to the legislation. We as a board can take a look at it, realizing that it's a one-time shot. It's kind of like looking at the audit today and finding out they went bankrupt yesterday, the day after. It's that kind of concept. The one thing I would argue for the statewide assessment at this point in time is we're gonna run out of 4% money, those types of LIHTCs. If we had a state assessment, when in fact we run out of that, private activity, that may be a good way to in fact say, okay, too much for Bozeman, we need to go over here. Well, too much for Missoula, we need to go over here. That could be very well, and could very well justify what we do. Now, when we run out of those private activity bond caps, who knows, but the problem is coming sooner than later, first of things. So I could argue from that strength. I don't know that I can argue from what we do come. Other than from a political standpoint, then Casimir.
I'm in favor of more information. I think just to counter the point about for the individuals, obviously they're anybody who doesn't have a home is going to be in need, but I could also see that a higher percentage of unhoused people can have spillover effects for the community as a whole. So I think it would to know what certain suffering also.
I'd be interested in, Rachel, are you still on the phone?
Yep, I'm here.
So, yeah, I'm just curious, and thinking about, the tribal areas, the 7 throughout the state of Montana. My inclination is to say they're gonna come in as the lowest entities. And I'm interested in your thought process on that.
By lowest entities, Jeanette, you're meaning where the housing needs are the most.
Yeah, how is, yes, correct, yeah.
Yes, excuse me. Yeah, so when you talk about reservations or tribal land, from what I'm not an expert in that area, obviously, but what I hear at different meetings is that there's not enough housing for the amount of people living on the reservation. That's why they're moving to urban areas. And I don't know, what was the next part of that question?
Well, it was just mostly about, you know, I'm looking for you about a survey, the realities of what that will show. Truthfully, my sense is that's, you'll see that would be my sense. I may be right or I may be wrong, and I just didn't know if you had some insight into that.
I don't have a lot of insight, but I can definitely get information for you, to know more about that.
Yeah, I'm sorry, I didn't mean to put you on the spot, actually, so.
No, you're good. I'm not well versed in that portion of, tribes. But I see lots of studies that go out, so I'm more than happy to send them your guys' way and, we can discuss further.
No, need to look into it, but I'm having a vague recollection that there have been a couple of tribes in Montana that have undertaken their own tribal housing needs assessments. And so I can look back and see, when did those occur, which tribes have those in place? How did they proceed after they gathered that data? I think with a statewide housing needs assessment, it's not gonna get too granular, it's gonna be fairly high level unless we specify it otherwise. So I think one of the things that Commerce had been chatting about building out, and I'm not sure where the stage is a community planning platform where we could highlight or link to regional or tribal housing needs assessments that have happened throughout the state already, because a lot of them are out there. And it's just hard to, find a one-stop shop to, okay, well, what's the assessment in this area? And so it'd be nice if we could do some support work around that. Joe, do we got any comments or we good to go?
I don't have any.
Sheila, go.
Okay, they're probably gonna regret giving us this model as an example, but if I look at the one that's on the screen right now, second line from the bottom, there's 5,900 renters. And on the far right column, the shortage of units is 63,000.
Yep, that clearly looks like a error in their data. Good call. Yeah, and this is why we're showing, this has been a work in progress for Builders Patch. This isn't like a line where people are actively using this right now, to my knowledge. And that's why we have Ben Gill, the economist on our team, involved in this, and Builders Patch is gonna send us all of the underlying data sources and methodology, so we can really vet it well on our end to ensure that it's statistically sound and makes sense. Because yes, Sheila, we would not wanna send something like this to the board where your affordable housing ratio is 5,252.3%. That would not make sense.
So I do want to go on in favor of having something like this done if we think the cost is reasonable. I think a lot of us as board members do these kind of calculations from the data that's presented to us already, but I myself don't do it as scientifically as they're going to do it here. So I'd like the data as long as it's reasonably priced.
Yeah, and my response, Sheila, to everybody is that, my mind says, I'm hearing that they don't vote for 3 years and we spending $300,000 for something that has to be done and doesn't stand the test of time very long. And that's not comfortable for me.
Yeah.
In truth, what a way to just want. I think that means of what a year or two. It's just like you throw it down the toilet. And I struggle for that.
Yeah, and right now, aside from if we procure this additional data set that we're exploring with this vendor, Builders Patch has been working on this housing count kind of on their own accord, and this has not cost us anything additional. And they haven't asked us to pay anything additional. They have some goals with additional GIS mapping features that they want to partner with us on. We have that housing preservation database on our website that's really just a big Excel spreadsheet of not just the affordable properties in our portfolio, but other USDA, RD, or HUD Section 8 that we're not involved in. And we would like to leverage Builders Patch to do some GIS mapping of here are the preservation opportunities around the state as a resource for developers to say, hey, we've got an RD project that's going to roll out of its affordability in 4 years. This is a real opportunity, and to highlight that. So that's kind of a phase 2 part of this work with Builders Patch. But again, it's kind of conceptual conversation now. We wanted to bring it to the board of, would these things be helpful, either statewide housing needs assessment or this or both? And we don't have to make a decision today. It's just to get input from the staff.
And I would just say, it's really hard to solve a problem when it's not clearly defined. So if you don't have any numbers to it,
You know, it's, again, you know, in the audit, they said that we're not directing our LIHTC projects to the right areas. Well, what are the right areas, you know, and unless we're all looking off the same data, I think we've all received multiple ones from a certain community, and the market analysis is like, we're short this many units, and then the other developer says we're short this many units, you know? And so, again, I think it's a benefit to not just the board, but to developers as well, to be able to identify that.
Logan, you can go ahead and stop sharing this screen. Jason, is there anything that you want to add from your perspective as far as, or your kind of, if the board decides we want to do a statewide needs assessment, we'll proceed as needed?
Yep, good to go if we want.
And yeah, I would just encourage board members to kind of, you know, you can click on the links in the electronic board packet to see some of these other statewide needs assessments, because if we do come back for, hey, we want to, you know, move ahead with a request for proposals, we'd love to get board members insight about any particulars of what you're looking for in that statewide needs assessment. So there's several samples for you to look through here, but there's also many more out on the internet. So give that a look, so we'll have it in the presentation. So we do have lunch now. We're running about a half hour early. So are they delivering right at 12:45, or is that?
I think that's them gonna set up right now for the 12:45 lunch, so.
All right, well, I think we can go ahead and pause. We're gonna resume this meeting at 2 p.m. With the reverse annuity mortgages conversation. So for those online, please be back promptly at 2. And we'll resume the meeting then. Thanks, everyone. All right, it's 2 o'clock, so we're gonna resume our meeting. Folks online still hear us okay?
I can hear you.
Okay.
Right. So I'm gonna turn it over to Jessica Michael to go through the reverse annuity mortgage program discussion, and take it away whenever you're ready.
Okay. This is a maximum loan amount discussion. So since the inception of the reverse annuity mortgage program, RAM program, 251 loans totaling over $16.5 million have supported Montana seniors over 68 years of age to remain in their homes. RAM loan recipients have benefited from monthly payments to supplement their income, as well as pay off debts and make updates to their homes. The program has lent not only to traditional stick-built homes, but also manufactured homes, condominium homes, townhomes, log homes, and even one classified as a covered wagon, which I believe you were all given a copy of my previous one of this, and I had a picture of said covered wagon style home. If you wanted to see what that is, it lives in Sidney, Montana. As of September 30th, 2025, the RAM program has total cash available of a little over $5.8 million. The current total amount pledged to active loans is $1,139,893.98. Active loans that have been approved and are currently receiving monthly payments. This leaves a total available balance of $4,724,165.36 remaining to lend to qualified borrowers. However, the board does need to retain some level of funds to front monies for property taxes and insurance for RAM loans recipients who have achieved all monthly payments back, but who lack sufficient resources to pay these costs. So the total cash available is the $5.8 million, and the pledged amount on active loans is the $1.1 million. And that leaves us with the $4.7 million left to lend. Currently, the maximum RAM loan amount is $150,000. The board has received applications with small primary mortgages outstanding, but the balances were just slightly too large to take out with a maximum of $150,000. Taking our available funds to lend and dividing it by $250,000 would equate to the board's ability to lend to approximately 18 or 19 more borrowers. Maintaining the maximum RAM loan amount at $150,000 would equate to another 31 to 32 borrowers. Montana Board of Housing staff requested the board discuss raising the maximum round loan amount from $150,000 to $250,000. Although this increase would reduce the number of borrowers the program could assist by 12 to 13. Increasing the maximum loan amount could open up the program to potentially assist borrowers that have increased needs to pay off their remaining mortgage, update their homes, pay off debt, or a myriad of other beneficial and stabilizing uses. Administrative rules gives the board the authority to set and change the maximum dollar amount of the loan. And then I have the arm there, 8.11.405 income limits. Where it talks about how the loan amount may not exceed 80% of the appraised value of the property. And then the board will set the maximum dollar amount. So the discussion is, would we like to take the remaining money that we have left? Potentially help more borrowers not have a mortgage payment at all, possibly being able to pay that off. And not have one, and help fewer people, or stay with what we have now and help the remaining 31 to 32 people.
My first question, go to 586.
That comes from, that's all the funds that have been set aside for the RAMP program. So over the last.
I mean, it's not 6 million, it's not, no.
Oh, yeah, so I think that board had allocated a certain amount to the RAM program initially, and then, we received interest back on mortgages. And so that interest just goes right back into that pot of money, so it comes out. And pay our which, yeah.
Is there some external mechanism or regulation or reason why the board in its wisdom at that time allocated this amount of funds instead of this amount, or is it feasible for us to add an extra million?
If there was money available within the indenture, because this is indenture.
Right. Yeah.
Right now in special reserve, which is where these funds are, we have 400,000. What color is it? Green. Green. So that's what we have available in special reserve, so we have to deallocate some of the combined revenue or imaginary fund in order to, make that $1 million, and then we have to do cash flows and make sure that there was enough in the indenture without those funds. And then the 150, I think I remember, right, just having gone through some of the board minutes and stuff on the RAM program, I think that's where it was set way back at the beginning of the program.
Like 1989.
89, so that was probably a lot, decent sized mortgage for the time. And it was probably fairly high, and now it's not. So we get borrowers who call, who have, $175,000 mortgage.
240.
Yeah, that they want to be able to, pay off and get a reverse mortgage, and we have to.
One more question. So how do people become aware of this program? How do we market it, so to speak?
We did a marketing campaign last year where we Julie Hope went on to the senior.
The Aging Horizons.
Aging Horizons program on Sundays, I think except. We market to like NeighborWorks knows that we do this program.
Okay, yeah.
Different entities know.
We
that
did
have-
some PSA type releases. I did a couple of a series interview with a reverse annuity mortgage publication with Chris Chow. So yeah, we tried to do a pretty blanket, spent some money last year, and we did have an increased application volume. It's kind of slowed off. So I think we reached out to the Aging Network folks that Amber had suggested at a prior meeting. We didn't really get much sponsor traction. But I think we can make another attempt at that. And then I haven't talked with Jess about this, but we're having some additional conversations with DPHHS on the rental assistance program side. And we're going to be doing a training with some of their caseworkers out in the field, which could include some of that aging disability services sort of folks, and I think this would be a program I want to highlight for partners and HHS and their network of providers. to
It
identify.
has a cool ripple effect. A lot of social services, I would think, if you can keep people in their homes, there's a lot of positive, a lot of that for the rest of them.
Another thing that could happen too is that somebody that already has a RAM loan with us, would we allow them to refinance, pay off that and take another $100,000 draw or payments out?
Or would this be a going forward change only? So, you know, if we brought it back to the board with, okay, going forward, we approve it to be 250, but, you know, we would not extend that option to people that are already in program. So that's the figure too.
Yes. Thank you.
So if we 150 or 250. And we're at 80%, what interest rate are we charging?
We charge the 5.55.
5 rate, how many years till we get 100% value? Cause the interest just gets added, right? 7 years? What's the time you get phrase back?
10, I mean, because we take that into consideration when we calculate the amount of principal. Yeah, it zeroes out, it's supporting about 10.
10 years, okay. Okay, so at 10 years, as long as the market went up, we're fine. If we have a crash, we're on the one. And we eat, right? It's hard to eat. Okay.
These are not insured bonds.
Yeah, they're getting eventually.
How many RAM loans have we ever had? Due to death and then take ASM?
I think there's been, I'd have to confirm, but I believe I can remember 3. So Sam, that we, run through the corporation process on, and I don't know about losses right off the top of my head. So you can see what
And yeah, that's kind of the negative thing is a lot of these end up being into disrepair and the person passes away. Passed away or.
Right, right. So my final question is relative, excuse me, relative to the program, not the interest, just relative to the program. If we say, okay, here's 75, here's 75 pay off more and 75 do repairs. Do we monitor the repairs or just give them?
We had the one just recently where you guys wanted to know the windows and the doors.
Yes.
She's recently passed away. As a side note.
Okay,
But we did follow up with, the contractor and giving a bid, and knowing that it was a legit contractor that we were.
so
But normally I don't think we do. Normally it's pretty small things.
so which, well, if the appraiser was legit, we don't have an issue, if it wasn't under that stuff, right?
Right, well, we had one that was subject to a railing being put in and we made sure that the railing.
And the, upfront, the release of funds, we can only go up to so much without the board, approving a lump sum upfront. And it's, I think, 30,000 that we can do initially. Otherwise, we have to come back to the board and you guys have to approve that lump sum. We don't just give them the 150. So we can give them a small portion of it upfront. And then anything beyond a certain point, the board has to approve that lump sum, which I think if there was a requirement, I think in the past, there's been that requirement, they had to have, you know, bids or repair work had been done before those lump sums.
So if we approve one at 150 and all goes out the window that day, they sign on those, the president said, it all goes out the window that day. 75 pays off the mortgage, make sure it gets paid off. And then we have a mechanism by which you, yeah, a mechanism, give or take, but we can track the repair to them.
Jessica, are you basing, maybe it's just not, the recommendation to go from 150 to 250 based on the escalation of home prices and the reality of the city's market?
Yes, that and having multiple requests for, I wanna be able to pay off my mortgage so that I don't have to make that payment. So that basically that in turn supplements their income, because they don't have that payment plan. Multiple requests for that we've had to turn away and say, sorry, we don't need lend on.
Do we always lend out the max?
No, not always, most of the times, but not always.
And what age do you have to be qualified?
68.
68.
And Brian, when we say lend it out the minutes, they may sign a note for the minutes, but it's. Whether they stay in the home or not is what determines whether or not we actually pay it out. That's relevant. Because if they leave the home for 5 years, then payments cease and then. On, you know, if they go in nursing and pass, you know, then they stay. Because it's.
Sheila or Rachel online, do you guys have any questions or comments on this agenda item?
Just one quick question. One quick question is, what do you think our demand will increase to annually? Like, is this 13 loans 2 or 3 years worth of loans before the money's used up? And I know you're just guessing, but I just wondered what the estimate was.
Haven't thought of it, but yeah, probably 2 or 3, depending upon if it goes by gangbusters. If it goes gangbusters, it's gonna.
Then I think I have a question for Nina. So we talked about Raspberry money early on and talked about what the amounts left in that. Is that an account that also grows over time? If we don't spend money out of it, does it naturally grow?
Yes, except for the fact that I believe we budget almost $4 million in for operating expenses, so we I don't think we take out 4 million every year. It really does, but it's budgeted to take out 4 million, so you're gonna get interest earnings off of that. You're gonna have naturally bonds that are going to mature or wind down or collapse, whatever the issue is. But you also have an annual expense of up to 4 million.
Thank you.
I just had the same question about demand.
Okay.
Jess, I'm trying to think of how many done, what? 5 new loans since we did the marketing campaign, 5 or 6.
Yeah, I'd have to be sure, but yeah, it seems right.
About all there, so. But then had turned several away, so. My thought is, you know, this money's kind of been out there, it's been underutilized from my perspective, and. You know, I don't feel like it does us good to be sitting on money in a program that we're not making all efforts to get out to help Montanans who need that assistance. And so if we can adjust the maximum loan value to get that money out to meeting our mission instead of just sitting in a bank account and earning some interest. To me, that seems like the purpose of what we're here to do, even if that means we, you know, we bump it to 250 and then we have a run on the program and we lend out all of the available proceeds and then it's kind of gonna be dead in the water for a while, but at least it's working for its intended purpose, is my thought.
And so currently we have, there's 20 loans, where we paid out the max amount of payments, and we're waiting on payoffs on those, because we don't kick people out after the 10 years, they just quit giving payments. But their money is still due, and so we do see payoffs come in on a regular basis.
So is the replenishment opportunities that the only way it replenishes?
Yeah, and interest rates. Yeah, and since last October, we've done 7 new laws in the program. For a total of 759,000 of principal. That's what we committed to principal. We haven't paid that much out yet, but that over the 10 years, that's the amount of principal that we committed to.
And that's part of the math is, maybe they only took $15,000 and gotten another $20,000 in payments. We have to make sure there's enough money to actually pay out the rest.
Get back on the question. But if we give him 250 day one. Because we paid off a mortgage. And gave him a little bit, so now they owe us interest on 250, correct?
With 250. So the principal that they could get in that case doesn't include the interest, so I don't know what the split is right there, but. Because the loan amount, the 250 it includes interest.
It includes, okay, so we're never going above the 80% of the original appraisal.
That's correct.
Okay, that was my question.
Yes,
The MasterCard.
yes. I hadn't, yeah, up through exactly.
Okay.
Yeah.
So if we are to work up a agenda item for a future board meeting to propose increasing the max to 250, is there any additional things that the board would like the staff to consider and us writing that up? Thinking that going forward from a point of time versus do borrowers that are currently in the program have the ability to re-up to that 250, that would be a big consideration.
Cause that's gonna be the next question.
Oh, yeah, because now we're getting another 10 years, right?
Yeah.
Gave them 10 to begin with. I'm understanding of that.
Yeah.
That will be asked.
Yeah, it'll definitely be asked, and I want to make sure our staff is in a good position if we were to go ahead and we'd be able to say this is a going forward basis only, and we're very sorry, but that's the maximum loan to apply for the
That's fine.
program.
Yeah.
Yeah. Okay. Any other thoughts on this one?
What if we refinance the land on someone else? Well, you know, so it's a
And you get a payoff from
Yeah.
another.
FHA RAM, so. We ever done that?
No, we refinanced the board loan.
Yeah, but I mean, it's a land to a RAM. I think we shouldn't do that.
How would
Just
you
for
know?
the-
Would it say on the payout that it would have been more?
Title clause, I should say.
Yeah, that would be great. I could ask people.
It's,
We can do some investigating on that.
is it just be another way to keep extending my stuff?
Yeah.
My next door neighbor is in the reverse mortgage business. Remember one time you mentioned they've done 400 in the past few years. I don't think, maybe he's operating statewide, but this is just telling out there.
Ellington Bull?
Yeah.
Yeah.
I'm just curious what percentage of like this market, like how big is this market? It seems like we could be helping more people if there's more funding. And
So
Is that-
our market's really small, and that's kind of intentional, partly because we don't have an abundance of funds to put towards the program. But also, the costs on a regular on market reverse annuity mortgage, they're higher. You know, there's premiums and stuff that they get charged. For our loans, they pay closing costs, title, closing costs, and they pay for the appraisal. And those are really the only costs that the borrowers have. And the income level that we're serving versus the income level that they're serving, there's a difference. Ours is
200%
200% of poverty
is very low.
So we're really catering our program to low income seniors.
thank you.
Okay, well, I think we can pause for a few minutes. We need to not start the QAP until precisely at 2:30, so I think we could just mute ourselves for a few minutes, and then
Mark this,
good afternoon, everyone. We are now moving into our informal public comment hearing for the 2027 qualified allocation plan. I'm gonna turn it over to Jason Hanson.
Okay, so this QAP session, we started having QAP meetings with the public back in May. I think we had May, June, July, I think we had in August, went really smooth, so it's a pretty short list this year. So that's nice, so basically, we'll just go over the summary of changes. So it's pretty short. Can everybody hear me? Sheila, can you hear me? Rachel?
I can hear you.
I can hear you.
Perfect. Okay. So the first one is on bond deals, if we become oversubscribed. Right now it's a first come, first serve. We want to change that to, if we're oversubscribed, staff may schedule bond closing irrelevant of submission date and use factors such as readiness to proceed, the amount of bonds, available bond cap and so forth, so we can make sure we get as many deals closed as possible. Anybody have any questions on that section or comments? Okay. The next one, clarify a separate application will be submitted for multiple site projects and that limitations will be applied on a separate and or combined basis. Like right now, we just closed Montana 6, that was 6 different properties, so we had an application come in for all 6 different properties. Plus a combined application, just wanted to make that clear that everybody knows we have 6 applications come in. Sometimes they will, do different things on each one, so the DCR might be a little high on one and pretty low on the other, so then we can look at it on a combined basis as well. It's kind of just on an ongoing basis, what makes sense, Chase project.
DCR.
Yeah, coverage ratio, sorry. Yeah, debt coverage ratio, yep. And soft costs and stuff like that too, so we have different threshold unit costs. So it might not pencil out on one project, but it does for the whole combined application.
That's why we get them, right?
What's that?
And that's why we get them that way.
Yes, yep, yep. Any questions, comments on that one? Done.
Jason Dunster.
And be sure to speak up really loud to the audio.
Thank you. Just a curious question. We're talking about affordability. Are there some economics or there's some savings if we have splitting and firing becoming separate applications? Have all the duplication costs.
Mhm.
Do we do it as
One combined? Well, I know we have a lure on each property separately, so I'm not sure that we can still do that on a combined.
Hey, Jason.
Yes, Bruce.
Hey, this is Bruce Brenstall. I work for Jason. The main reason is most of the time these are on separate projects and many times in different communities. They all have different income, limits. Every once in a while you get the same, like our Anaconda project that's in basically the same area. But even with that one, like Jason said, we have to do separate LURAs on all of them in order to get all the paperwork together. So it really kind of makes sense to do a separate application.
Thank you.
And Laura, acronym land use.
I need to restrict
Agreement.
agreements, yes. Yep. Any other questions, comments? All right, next one on 4% applications, we have in there that you need at least 6 weeks to underwrite. We're changing that to 8 weeks. Just right now, our lead time for board docs is almost 2 weeks. So that really only gave us 4 weeks before to get everything done. So we're just putting 8 weeks in there now instead of 6. Next one. Also, we've got a little oversubscribed on volume cap, tools we'll use to manage it. Right now, we limit the amount of bond cap at 60% of the total project. There's such things now as the 25% test instead of the 50% test, so we can work with different projects on how much bond cap they really need for the project and maybe get it down a bit, so we are bond cap constrained, maybe a little tweaking on a couple projects would help alleviate that. So just putting language in there just for some flexibility basically is all it is. Questions on that one? The next one's really simple, at pre-application, which is now pre-application, not LOI. Letter of intent. So at that stage, we will accept a full market study before we had a mini market study. And one of those reasons is with different AI capabilities that we can pull out of that market study, everything we really need out of there without having to have implication on a mini market study and a full market study.
But they can still submit just the minute.
They could, yes, that's all we're looking at. Yeah. Next one, and so average income on the 9% round, we had if you were a 40-60 selection instead of average income selection, which we wanted an average income of 53% total for all the units, average income. But if you were doing average income instead of 40-60, you could go up to 60%. We're just making that consistent across the board that all average income for all our 9% applications will be at 53%. Any comments on that? Okay. Next one then, language to handle exceptions consistent with DCR and soft costs. So kind of a question for the board, right now in soft costs, you have the 40% and the 45% soft cost ratio. And if they're over, they need a waiver. We were looking at maybe making it consistent with DCRs now, as you will see tomorrow, we're gonna have some DCRs that are well over the range that we want them to be in. So we could make it consistent with soft costs and have them get a waiver from the board to have DCRs that high. Or we could keep it as is, where we would work with them to lower income targeting and some other things to get it into that area, like between a 1.15 and a 1.5 DCR. So I guess to the question to the board is, would you like it to where they would come to you with the waiver request on that, or would you like the staff to handle it as is right now and work it out with the projects?
I'd rather that handles it. Which is a straight waiver. You probably will.
I think about that one. And I have to agree, we should have a problem with waiting. But as much as I think this problem has been abused. From our standpoint, my standpoint. I'm not sure about it.
Okay. And all we were doing was looking at making it consistent on both, so whichever way you guys want to go. So Heather, just to fill in what we're talking about, is the DCR, making it the same consistency as soft costs. For the board to have a waiver if it's out of the range that's wanted, or to let staff handle it. So that's the question or comments I'm taking.
So what would be the pros and cons from like the developer perspective? So if
So-
I'm a developer and I'm, you know, outside the range, if I need to wait for a waiver request to go to the board, and time is money, so there's that aspect to it. What other kind of pros and cons?
So right now, they would work it out with staff, and I would guess if they couldn't work it out, they would have to go to the board anyways and get a waiver for it. Basically, it's just cleaning up the language to make it consistent in the QAP, the soft costs and the DCR would be the same.
So we don't confuse ourselves with, oh, which one requires a waiver?
Yep.
So-
Yeah. The next one on home ownership, projects proposing eventual home ownership are required in the plan to document how restrictions on future sales will be handled. Right now, we don't have anything in the QAP if after the 15-year period, we have home ownership. It doesn't say on subsequent sales if they'll be income qualified or not, or how much, you know, can we make money off of it. So it's gonna be on a case-by-case basis, mostly on restrictions on any subsequent sales or transfers. The eligibility of buyers will be taken into consideration, limited on equity transfer, and if revised LURA may be needed to ensure. Comments, questions on that? This is 15, right? So at year 15, we look at some of the tribal ones where they've gone and done home ownership, so you have to wait till year 15. So on year 16, they can actually have home ownership on it. And right now, so say to get home ownership in our lures and so forth, we don't have anything about reselling it, for
And keeping it within.
income and, equity and so forth, yeah. Alex?
Alex, my number is Housing Solutions. And see what you say, operating guidance, this is such a odd nuance.
It is, and this actually was brought forth to us, there's been some cases. Court cases in Oregon on certain lure things that it was an enter up front. And then they actually did home ownership, but then, that's taken away.
Tenants.
The tenants' right to actually, yeah, so that came to our attention when we were talking with Q-Tech and Wyoming and so forth on some other stuff, so we figured we better have some kind of language. In there, so we've had it before where we needed it up front, but we didn't have any subsequent sale language or anything like that. And we don't hardly get any of them, so
Yeah.
we just wanted it, it's kind of a placeholder right until we get an application to discuss how that would go. Great, next.
And to answer Alex's question, at least in the NCSHA recommended practices for life tech administration, I just did a home ownership search because I was on a task force and it was last updated, and I don't recall this being a discussion, and home ownership does not appear in that best practices. It is
It's such a
yeah,
narrow or.
Yeah.
Like less than 2%.
Okay, so the next one, I believe is project cost. Okay, so total project cost, unit cost. We're proposing to go from the 365 to the 395. I did get a public comment from a developer that is asking for 410,000. Along with a 10% buffer on cost overruns. So we did receive that this morning. Most days we're trying to develop in Bozeman. So we got that today, but I know we discussed the 395 at all the public hearings throughout the summer, and I think most people were pretty much in support of that.
I thought we heard 399.
I think I misspoke earlier.
Yeah, it's 395, so we had a company come in and we did that waiver up to 400,000 on that one in Bozeman. And they come in at 399 in their application. Yep.
And again, the enterprise community partners assessment that I shared, I think the national average was around 415.
Yeah. We have that as well.
Any other comments on that? Great. Next one. So allowing projects to issue or that issue bonds and then invest the proceeds until needed may net the investment earnings from the interest cost for the project uses. So that's actually gotten kind of popular this year. We've had a number of different developers come in. It's called now our cash back forward strategy, I think is what this called, to reinvest the bond. So instead of having that cost twice, we let them net that out. So it's, soft costs don't go over the 45%, so forth. So we're just putting language in there, so it's actually in there, so we didn't have that language before. Okay. Let's see. Next one is 64, so small rural projects. So right now, 12.5% of the money we have to award, and the 9% are for the small rural community. Set us our, yeah, I can't think of it, spotlight. So we were looking at going $4.5 million, because we don't know exactly how much money we're gonna have come October for the award, so we just set it at a straight number. In the summer discussions, we also had passed was the extra 12% from the IRS, which would make it over $39 million instead of $35 million. So we actually, instead of 4.5, want to make that $5 million, because if we took 12.5% of the 39, it would be $4.9 million. So we're proposing $5 million instead of $4.5 million on the small rural projects.
You know, it strikes me that 4 years ago, we were 250. We've gone up over 50%. Gonna go into nowhere, Montana, and 500 bucks. I'm going.
Any other comments? Josh, Jason, yeah. Five. Yeah, so right now, this year, it was, you would have to be under like 4,412,000, you know, so nobody knows how much that 12.5% is. And we had projects at the LOI stage come in this year and asked what the exact number is gonna be, and so they knew when they sent their project in, if they would be under that amount. So we figured it'd be easier for you, all developers, to plan ahead of time if we had an actual number just set in stone, instead of off 12.5%. So we're just trying to make it easier for people to plan on what that number is gonna be. So the proposal now is gonna be 5, not 4.
And it might exceed 12 and a half.
Very, yes.
Yeah, but I mean,
Yeah,
the 12 and a half's not in stone. 5's in stone.
5's in stone, yes. Yeah, but it just makes it easier for everybody to plan a year ahead of time when they're doing their applications.
I agree.
The version that came out in the packet still says support.
Yes,
Okay.
yeah, yeah.
This is kind of late breaking update for our thinking through with the One Big Beautiful Bill and that 12% increase. And we're still waiting for the IRS to send that corrected amount of what it's gonna be for this year. So that's a little frustrating, but I think over the summer, that hasn't been a robust part of the
Yep.
prior workshop conversations and of staff, something to talk with them more and try to align that, so.
Okay. So that, the minor changes are basically just the year. The approval updates, the terminology like letter of intent will now, and application will now be called pre-application and full application. Change submission from OneDrive where send all your documents in to the application platform, which would be Builder's Cash, but we didn't want to put specifically, you know, if we change platforms ever, we don't have to change that language. Terminology from Uniapp to Proforma, the Excel spreadsheet, and then board consideration section adjustment, the following bullets, since the 811 program is no longer relevant, so it's taken out, so.
And a little bit as to why the 811 program is no longer relevant. It's still relevant, obviously, but third in the program. So 811 is a project-based federal rental assistance program that serves non-elderly persons with disabilities. And our rental assistance bureau in the broader Department of Commerce Housing Division was awarded a 5-year demonstration project under that 811 program years ago. And that program is a little tricky to administer, and it requires the owner of the property or their property management agent to pay for and have an additional HUD system for the reporting. And that was a bit of a barrier in getting owners to sign on to be in that program. And there's some other reasons that have made the program a bit complicated, but this last September, because that was a 5-year demonstration, we had to report back to HUD with our expenditure plan for the remaining funds that we have. We have no admin dollars left in this program. And we will be moving to have an annual contract now with HUD to provide the rental assistance for the projects that have units occupied by eligible 811 recipients. And it's a fairly small universe. I think we'll give you around 1.5-ish or so right now. So we had included 811 as one of the board's considerations to try to get some synergy around developers that were proposing light tech to be willing to have those 811 units on either their light tech proposal or another unit in their portfolio. But Commerce, we don't have any more flexibility essentially to move around those 811 projects. So.
Alex, you got something?
Yeah, we did have a. The letter we sent.
That would be my fault. I remember you sent it and it's not in there.
Okay. So, and I probably should have brought this up. Alex for Housing Solutions again, when we were talking about the smalls project, set aside numbers of 1.5 versus 5 million. I'm gonna stand over just on that. Although maybe you want me to say something. And the letter really says it better than I can, but, it's the same idea of adjusting the 4.5 million to 5 over the summer with the one big beautiful bill. Right, they increase the credits, and then, there's more frustration for Cheryl and Jason. It's kind of funny for me with the IRS and Blue announcing how many credits each state is gonna have. But, long time just developer nerd, we, a lot of years, I guess the history I shared, for a lot of years, the board standard was always that no more than 25% of the credits could go to the project. But he just want to make sure that these projects done. Then we wind back to the Tax Cuts and Jobs Act, there was a 12.5% increase in credits. We said, hey, with these additional credits, I think we can push this to 5. Let's try and get 5 jumps in. Then that expired, there was 4 years, then we were down in credits again, so we actually went down, possibly expired. Possibly, picture of down. There was a couple years like that, and then this one big beautiful bill brought that 12.5% back, and it's permanent. It's not even saying, so we don't have to worry about expiring. So it kind of brings that same question back up: is do we want to pick a number that we think will give us enough for 5, or enough number that's enough for 4? Where we're sitting right now, 8.5. This is why we can just watch it, but it's 4.5 projects. Basically, there's enough money for 4 and 10, which, based on what you guys are looking at, now actually worked out really well. What's 6 beds? But if you didn't have any small projects of 5, it would leave you with basically a after project. Maybe if that's what you want to do, so that's 4 one year, 5 the next, then you've got it. So all I'd ask is just consider that 8.5 million is kind of an annual version when it was up 512. So that's what the order says.
So Alex, if we're saying if we do 4, then we have to carry it.
Correct, with 8.5.
Yeah. You got
8.5 the max, and you get 8 applications, and everybody's asking for essentially.
exactly.
You'll be able to fund 4, and you'll have pretty large amount of credit. So, or you could say, we're gonna increase the 8.5, and now we can only fund 4, but they'll get some more credits once they're bigger units. Or you can say, all right, guys, we're close enough to come. Let's bring it down from 8.5 for the try to get the fund. So I'm gonna bring it down to, I don't know.
So I was gonna ask you next.
That's what you guys need. No. I mean, as a developer, selfishly, I like the idea. Or a number of them. Selfishly, as a developer, I like the idea of a lower number because then I would fund it about 4.
But they're not 100% funded at 5.
Well,
I mean,
they could be, because we'll just, as developers, we'll know this is max. Solve for a project that works.
So right now, as it lays, we could actually do 4 full projects plus the small one.
Plus the half.
4.2. Yeah, so we have a small project this year at $4.2 million. So we're, how the numbers work, I mean, you can look ahead if you're a developer and say, there's plenty of room for a small development, rural one in here. So
That's a very fair point.
Yeah.
As a developer, you could look and go, if I bring something in at 4.2 or 5 or whatever the number ends up, there's a pretty high likelihood that I'll get that. But I think that's going to have to be actually which maybe policy is, hey, let's structure it so we get that.
And food for thought, just to carry on with that, and I headed here to bring up, if you look at projects like tomorrow, we upped it from 6.5 last year to 8.5. And folks would be getting more units that way, and you will notice some did up the units for 8.5 and others kept the units almost the same as if it was a 6.5 million. So that was an interesting caveat on what came in this year. Heather?
I was gonna say, your original point of bringing this up was to change the percentage to 50, right?
On the small work,
Yes.
yes.
I think that's a good thing to do, because we can't pick, how much we're gonna have. And then I would assume if it's 4.5 to 5 million, it's very similar to the 850. We can adjust it down the road if we need to,
We could,
right?
and we did discuss, you know, changing, maybe we do 8, right? I think Alex had brought up, and we thought that just by 8.5, we didn't want to change it every single year, so maybe a little consistency at 8.5 again, and look at it again next week.
Yeah, and I don't think you need to change it every year, and I was kind of absent for the last couple of months, the family stuff, so I didn't hear the whole conversation, but as long as it's a tool that we can adjust with the market, we don't have enough resources to build what we want to build anyway right now, right? We wish to need around the state, but I don't think it's a bad thing. We're in the 5. You have a lecture on the larger projects now and maybe those things come over. I don't know what the answer is.
I just, the reason why I wanted to be considered is because of the change to the law. We gotta move out of fencing, so that's.
Yeah.
Good for that.
Thanks, Alex. The last thing I wanted to bring up then, we're also, it's not in here, we're looking at adding in, and for the meeting in November. Is just to add that support letters will, or non-support letters will be due 2 weeks before the board meeting, so it lets us get it all into the packet, and we don't have a whole bunch of comments at the end that we're missing. They can, that's what the public comment period will be for during the meeting, so we're just gonna put that in the QAP. We've kind of done that before, but we just wanted it.
We need to cover these 2 bullets here.
Clarify rents 20% allowed, yes, so it was either last year or the year before, you know, on a 20%, we went up to 29. But when you calculate the average income targeting percentage based on the area median income rent allowed, there's just some language we wanted to fix in there. And appendix B, design requirement clarify, a play structure is not required, but if provided, it must have fall protection.
Are there any other changes that either developers in the room or board members are interested in discussing for the 2027 QAP that we did not cover in our?
Yes. As we've had discussions, I think the stacking credits is more legal. Should not be done. Get a credit 1 year, you should in fact have to go forward with it, not wait to try to get another project the next year and stack the credits to get their place. This became before the board members at the meeting in New Orleans, they were fault. But they agreed, they felt developers were doing that to them. And I don't think that's right, we're losing a project for a year, and that should not be the case.
So that's something you think we should have in the QAP?
Yes, I do. Now, most of them said, well, you have to build and just take care of yourself and don't get put. But that's just wrong. It keeps developments 1 year later in the project. We need all our projects to get going now. Whatever now is, but it's not a year. It's now. Therefore, I think that should.
So then language, something to the effect of, you know, developers must proceed to price tax credits as promptly as feasible, and that pricing cannot be held to be combined with another project down the road.
That would be in essence, yes.
And what happens if they don't have it done in that pricing in a year? Are the repercussions or what happens?
Well, the repercussions and the other boards, they just wait for the
Or the next round?
next round. They just said you.
So it's multiple years of awards. I mean,
Well, it's multiple years of awards to get more tax credits to get a better pricing on the tax credits.
Different.
Different projects, so the scenario would be, developer is awarded a 9% tax credit, you know, tomorrow's meeting. But they decide to hold on pricing those credits until the following October in the hopes that they will be successfully awarded another 9% deal and they could price those projects.
Interesting, I mean, I didn't intentionally do that because we haven't taken a lot of, should have 9%.
Yeah, I think,
But you can match 2 4%. Right? So it could be 2 4%, so yeah,
but you're not waiting for any of that.
Yeah, that's not a,
no,
yeah,
but if you putting one together or something, it might be 7 8 months down the road for the second one. I don't know.
I guess my just initial reaction to that is. Make the developers tell you what they're trying, and if they're not sticking to the timeline, then. We don't already do that.
We do, and they do check the shop. So we have implementation schedules on the 9% round, and they do change 3 4 months after they're awarded.
Okay, so then with Mr. Bose's recommendation, consequence, it's being made, it doesn't exist. Because it is, the criteria is still there. That's the time, what's your readiness to proceed, the evaluation criteria is pretty clear. Readiness to proceed, then if you all of a sudden say, yeah, but I'm not gonna do it this year anyway. It should be.
is there a consequence if? I don't know how you tell intention, but. As long as there's a cap, if there are delays for various reasons and we communicate to you, that's not an intentional delay of not your project done, but it could be factors that can be like getting your project initiated. I'm just thinking out loud, it's not a. Nobody wants to wait to do that, for very valid reasons. There have been delays. There are kind of three months.
It seems like the consequences are. I'm on signaling next week.
That's what you're doing.
Yeah. Yeah, that's what I'm getting at, yes.
And maybe it's as simple as the project's running behind schedule for the application, but. No, it's. No, it's.
Well, and I don't deal with Wyoming told me that's what they do. That'd be correct, and that's what Wyoming.
I know, good.
And I was just telling you, like, here I am talking tough, but we've done enough projects that. I've had to go and say. We're grace here,
Yeah.
so. It does happen.
But if you can't deliver on time,
If you're kept, that's a problem. If you're saying, I can do one, if I get two next year, that's a problem.
but even if you haven't delivered on the first one, why would you get a second one when you haven't delivered on the first one, right? Right. That's all I'm getting.
I did have a brief discussion with Mark Shelburne about this topic in New Orleans, and he may be online, and one of the considerations was, we always want to think through, policies and not adding policies for maybe a 1 or a 2 loss scenario, because that's how we end up with a very, very long QAP that we need to untangle, many years down the road. And with the level of board discretion, that we have in our setup, maybe this is a self-correcting issue. But what I've heard from, some board members is just it just doesn't sit right if the only reason communicated for holding on the pricing is to have a larger economy of scale to improve the pricing. That just may not sit well. And so I think that is the aversion, and there's probably a lot more nuance and context to these situations. But, if you're awarded a 9% allocation and are presenting to this board that your project is, ready to go and you want to get it going as soon as this award comes through, then if we, as a staff, are receiving updated, implementation schedules and everything seems to be, delayed, then that's, I can imagine being in the foot of the board members of, but you been tested at the last board meeting, this is ready to go, and where is this at? And, you know, we have board members who are very well connected with their communities and will drive by project sites. And if they see that there's nothing going on, I get a call or an email, and I think developers should be aware.
So,
Mark.
I am on, indeed, hello. I think I can actually even see myself there. How about that? And apologize for the background noise. These leaf blowers seem to get paid by the decibel, it seems like. So hopefully you can hear me. But that is, you exactly recollected, at least, or recollected the same way that I did our conversation, that it's important to not overreact to unique circumstances. Delaware, for example, didn't set out to have a 150-page QAP, but it does now, I suspect, in part because of thinking they needed a rule to address every circumstance. And so, given the extent to which your board has discretion, I think it's even less necessary there than it is in other states. I obviously don't know hardly any of the facts there, certainly a lot less than any of y'all. So I can't comment on this, what should or shouldn't have happened in this case, but just the general observation that when you've got a unique circumstance, it's okay to not immediately come up with a rule about it.
so would we be good then just to play comments like we do in the 9% round? Instead of putting something in the QAP for this, or how do we go?
From my standpoint, since I brought it up, I think comments are doing fine. But I think the board needs to understand what's taking place. Many times as a board member, we don't. Why is this not being built right now? Why is this being built? And we have a small group of developers, all good developers. They come in every year to us. Whether they got one last year, or they didn't get one. We see the same group every single year. And so they got an award. They said they'd have it started or done. Why isn't it? And we have the minutes that said exactly what they said. Probably the audio had exactly what it said, excuse me. And so, you know, they come in with another project. They said they'd have it done. Why isn't it done? And you want another. So I don't know if it has to be in QAP. I think Mark's right about that. We don't want a long one, but I do think we need to understand that those types of things take place. The other board members from the other states, they were very firm about knowing we'll get it. I'm not suggesting that one way or the other. All I'm saying is that we don't know that. We as a board members should in fact know that, particularly when we get, I don't pick on anybody very good. We get a couple board members who weren't here last time. You know, they're new. Oh, what happened? They don't know what was said. And again, we're gonna get the same group of developers on every single year, which is great. But we don't understand. But when they got a project, and said they do something, we need to know that it did or didn't happen.
I'm wondering if a way to solve the board members feeling like we don't have enough information is if we as a staff could review our quarterly reports, which we've augmented recently, and think through how to provide more granular updates to the board. It would be a big lift to do that, you know, every board meeting, and we only get the reports on a quarterly basis, but maybe at least twice a year, if not quarterly, to at least identify, you know, where in the stage the project is, you know, have they completed pricing, is, you know, partnership formed, have they broke ground, you know, whatever that status is, so the board members have a sense of how quickly or not so quickly things are moving along, and then that gives you more information to ask questions. Why is it at this stage right now? I would have thought it would have been a lot further.
So the last quarter, we added in, if there was any changes, right, then we pulled us, we started adding in to our dashboard, multifamily update at the board meetings. The ones that have been pushed back a bit, but some hiccups have started, would that be enough, Cheryl, or do you want more on top of that? Are you thinking, or?
I'm thinking we may just need to add a page, because sometimes there's like just so much going on that dashboard with, you know, the acronyms for the loans and the year and project name for 9%. And we have that little bit at the bottom.
We verbally went through it last.
Yeah.
too. So we went through each project that actually had delays, so we put that in the last quarter.
Yeah.
And we started that after the issues with Riverview a couple months ago, so that's why we implemented that last one.
We've had projects which we currently have one that's maybe 3 years delayed.
Yep. Yep.
And when I asked for the update, we didn't have that because the court was.
Yep, October or the 10th, yes,
So, I mean, so even on a quarterly basis, we don't have all the information. So I think even on quarter, we gotta get all the information. Now, that particular organization is not coming in this time, they're not part of this round. But had they been, that would have been a valuable thing to know that they would use rates.
I think Jason and I can chat. It sounds like, you know, we're providing the updates on what is delayed, but would you just, you know, do you wanna know just what's delayed? Or do you wanna know, like, where in state affairs are they, generally speaking?
That's what I.
Okay, so across the board for all projects, so then we can really see where they're at in the stage?
So on the dashboard, we have when we think that they will be finished, so that is fine. Do you want more than just what they're?
I don't like to drive by a project and say, it's not started. I don't want to do that. Yeah. I don't do that. I don't want to listen to a project and say, oh, by the way, we haven't found anyone to do it, and it's 2 years later. That's wrong. We have a limited amount of funds, $40 million or whatever it's gonna be, to get people in housing in the state of Montana. Every time we delay it and we throw this project in, we stop all these other families from getting into the Eastern Area project. That's not right. We don't have unlimited funds. We need to pick projects that get done and get done. And the time frame they tell us about, and we approve.
Jason, you know that, you would know, this kind of information that he's possible.
One, we just did the extension for it.
Yeah, and so. Talk to us about that. And
Yes.
why?
And that's why we started this last quarter, and we said we would update you every quarter, anytime we get delayed on one thing. That way, I'm like Riverview, all of a sudden, their unit cost year was way higher than anybody knew it was gonna be, so that's when I proposed we would update you with anything that changes. So that way, we get caught out of left field and they never updated us with their quarter reports, then that's a bigger issue because they never let us know.
I think it's important too for developers, because, you know, I think we've got more robust quarterly reporting now than in the past. Sometimes we would get quarterly reports where it wasn't clear how much in the quarterly report was actually updated before it was sent to us. And so, okay, is everything exactly the same? Is that really the case? And so I think that the new structure of the quarterly reports is a bit more robust and requiring people to fill out all of the line items.
Since we got
So that we have better data, as I think in the past, not all developers, that most of them do a very great job, but sometimes we get a quarterly report and it was, you know, updated date, but not a whole lot does.
So we're making them put pictures in every time, so we can see at least they're looking at it and putting new pictures in instead of everything's the same all the time.
Your time's down.
Well, not, we can tell if it's bare land and there's something enough. And then with our asset manager that we had last year, so he revamped the quarterly reports and he pushes back now if anything's missing that doesn't make sense. So we really upped it.
So do we, it's good with the asset management. Do we in fact say, okay, the board approved this project to be done on such and such a date? That's what we were told, and so we gave them lines and we said, they said it'd be this date would be for occupancy, whatever the case. We would record that so that that asset manager can look at that and say, hey, wait a minute, you said you'd be done with this project.
Yes, we have a history on quarterly reports now. We can go back and look at subsequent quarterly reports. Yep.
And Jason, you just made a reference about having them send us photographs, and again, fairly new to the board, but I know when I was building a house, the bank came by and took pictures. They didn't ask me to send the pictures. They didn't trust the builders who.
Exactly.
They actually buyer. Do we have an independent party going out?
We don't know, and we wouldn't have the staff to run around.
I'm not staff, I'm thinking of, you know, there's there's a cottage industry of people that do that for the insurance industry, for example. They go and take pictures of people. You ever had that? Somebody drives up to your house, takes a picture. It's kind of unnerving, but it happens.
Well, we do it on single family.
Okay,
We do it for delinquencies on single family. And they just do it right by.
But we're gonna, once you have a show up, you wouldn't know if anything's getting that inside. I mean, they have to,
get the access.
get
But
access
it's,
in there,
you
take
know,
pictures.
while it's getting up, you can tell the framing
Oh, yeah.
versus the, there's at least the beginning of the project that go without being in free, although you pretty point, they could drag their feet. That's where usually things slow down is once you have a shell up.
Yeah.
We do that for Lost Hill, and if you're.
Yeah, that's
We
what,
don't, it's
that's what Bruce was mentioning. And I think we have on a case by case basis where, we've had a project where it should have been, done. And we think we're there to do a place in service inspection, not quite done yet. And so we hone in on those issues and we'll do kind of like a construction progress inspection, but again, we have really limited staff capacity. There's 3 compliance staff and then the supervisor. And with the 4% tax exempt bond project pipeline increase, they're doing a lot of unit inspections. I can't remember if it was like 3,000 units a year.
Mostly 3 people.
And so one of those, they divide up the regions by 3 and they kind of rotate, but the person that has Eastern Montana, these are folks that are out on the road a lot. And so we could, based on quarterly reports and, risk assessment on our end, if we think we have a project that is, in a high risk area, see if we can fit those in. If we're already traveling in an adjacent area. But we wouldn't have the capacity just kind of across the board to do construction progress inspections. It'd be nice to have a, drone capability or Google Earth in Montana to be more up to date. There are some other GIS tools we see Heather how to handle.
I was just gonna say, this sells per year during construction delays. There's delays leading up to even needing to break ground. I will say, if we're talking about the construction piece, you already have, the bankers are already getting pictures that they can share with you and reports that, and we can make you guys part of the team. That's on the level, so that we help during construction, but I think it's on us to explain to you guys when we're waiting on soft financing to come in, or, delays that we can't see a picture of. So I think it's valid. They're very valuable.
We also added that too. The representation of making the application up front. Don't just go away. It's not, okay, let's keep them updated. But everything's changing, how my costs are higher. Not a problem. But these are the representations that we're signing on. You can think that's one. Let's propose this time. Because I can tell you, when I compete for a project, I know those are differentiating factors. But let's make cost per square foot, let's make cost per week, let's make cost per tax credit dollar in terms of efficiency. Not only efficiency of putting in financial underwriting, but delivering product. And then along the way, I adopt a philosophy sort of, maybe it's better to ask for forgiveness instead of asking for permission. Guess what? You know how many costs are. That's what's happening in other areas too, where we come and have 3 or 4 kids from the general country, general population, let's say. That's the best we can do. But we lease out to other developers. And I don't know where their construction comes from. And more opportunities, that's a wonderful thing. And as the year goes on, guess what? They can't actually do this. So I think it's great to have these mechanisms for updates. But let's not ignore the representations that we made from the
So, and that's why in our qualified hour quarter reports, we put in there now on thresholds, have your thresholds changed? Are you, so if your soft costs are over, your unit costs are over, we want to know that as soon as possible. that way, when it comes to the board and we were never notified, it's easier for maybe you to say no, because no one told us. If they would tell us up front, it might be easier for you to say yes. So after that whole run-in this summer, that's why we built up the, court reports even more. So we have, it's on them, and they never told us, that's on them.
The more information we as 7 members get, that we can make decisions that get housing on the ground for low income individuals fastest as possible, better off, our job as a board. We as the board make the decision who gets the money. Credits, excuse me, not the money, who gets the credits. And it's up to us, that is our fiduciary responsibility as far as I'm concerned. Get that money and get it out best use possible, and delays do not create the best use possible. So, yeah, that's why I'm trying to get.
Great, and I think it's a two-way street, so having that asset manager now on staff will have more capacity to receive and thoughtfully review and respond to quarterly reports. And developers that are providing us, a lot of candid information, like just tell it straight as it is. I think then that's really helpful. What we don't want to have is a check the box sort of exercise where, okay, I put in my quarterly report, we check that we received the quarterly report, but I've really been talking to staff that we have to really read and assess these and then disseminate the information that's held within those quarterly reports and disseminate that information.
And we've had some where, they will get told something, so we have talked with our compliance team about, if they're in the area to drive by to see if they say what it is it really that. So we've had those discussions over the last few months since the fiasco of this one or something.
And I think, and I would not suggest, I would suggest what you're suggesting. If they're in the area, we drive it. It's a simple deal.
Yep.
It's another 10 minutes. It's not a big thing.
And we also, Jason and his team, they have, I think it's a monthly meeting with the community housing team that does the CPD funds and some rental assistant staff for project-based properties. And Julie's team also goes out and does inspections. And for projects that we have shared, our staff is obviously communicating with each other. So we all are on the same floor of the same building. So, what Julie's team knows, then Jason's team knows, so everybody's on the same page. And I think that's one of the advantages that we have with all of our federal affordable housing programs being in one shop, that other states don't have that advantage. They, if we have an issue, we can all huddle, in 20 minutes and have a conversation in my office, instead of having to set up a meeting 2 weeks out to try to get all of the parties of the other funders in the state together to even have a conversation about it. So I think our team can be a lot more nimble, just because of how we're structured, which is fantastic.
And that full report isn't just timing issues either, it's the unit costs. They keep telling us it's in line, and all of a sudden at 8609, oh, sorry, it's $100,000 more unit than it was before. So it doesn't get solved by every single thing on the project.
No, but the quarterly report should have all that, so we understand what's going on.
Yep.
We're gonna have same discussion every single meeting, we're gonna have one. We need all the information we can have.
Yep.
Discussion.
Well, I appreciated what Mark said. This is a board that has discretion. And I think that was a really critical piece.
Yeah.
As much as anything that was said here. Sad.
Yeah, something we heard in New Orleans too, that meeting, a lot of boards who really come in, have very little discretion. So, so part of that is just kind of reading in the minutes for the world to see that,
Yeah.
The board may change over time, but here's what our position is, that, don't tolerate this kind of thing.
Great discussion, everyone.
Yeah.
Does anyone online have any other comments or questions on this discussion or anything that's proposed in the revised 2027 QAP?
And we've already.
Yeah, no better.
Mark is. Mark. Well, it's understandable, responsible to want to know the status of developments Remember, developers get paid only upon reaching certain mileposts. The key benchmarks include construction progress percentages, so they have as much or more incentive to move fast as anyone.
Precisely, yeah, and their investors don't get paid, sell the project is up and running, so, yes.
Team is tougher than you.
Yeah. I just, the only thing as far as what to do with the committee. But just put a firm, bold statement. The schedule you include in your application is what is expected for student. And if not, we'll have to. And I think just. There's no team in that, there's not a camera, but. Let's put it in there. It's an expectation, this is a clear expectation. You know, every QAP tells a story, that bullet. 3 or 4 of us sitting here go, oh yeah, I remember that. Don't mess around with your power.
So that could potentially be an insertion in the same spot that
Yeah.
requires the.
We have, the cover page, when they come for 9%, the cover page, the memo for each project, we have that spot right in there, if there's been any issues with that developer.
That, before we're reports, all that, when the developer comes to Montana, it's just, how do I put taxpayers to Montana, really? Yeah, and clearly says, follow schedule.
And if they don't follow it, we have that spot in that cover memo page, put in that they were late or they didn't follow through or anything like that.
But I think what Alex is suggesting is an actual sentence in the.
Oh, you want
Yes.
Yeah.
Oh,
Yeah, that says the implementation schedule included in your application is what we helped.
Yep.
Yeah.
Nathan, as our speaking attorney, are you comfortable in how you choose to read that statement?
Yeah, I mean, I can talk to Jason about how to word it, but I do think, I mean, we make it clear in the QAP. The board also, we do have catch-all language about discretion, which we do intentionally, but I think you're right. We make it really clear that in the exercise of your discretion, this will be a factor that is heavily weighted. And I mean, and I don't know, and you know, part of this, I don't say it's not taking over for Greg. I don't know if it's been a practice in the past. I don't know the extent to which there's staff reports on developers when they're applying at the LOI stage, because like Brian isn't gonna know whether on his first year if the developer 3 years ago was behind, right? I mean, but like, I don't know if there's been any historic practice of updates on, you know, like outstanding developers are applying, this is their performance for the last 5 years. I don't know if that's occurred or not, but.
we have a spot for that.
So, Cheryl, I'm just curious, again, coming back to national meetings. Do you and your peers, is there an ongoing dialogue or communication where you can say XYZ developer is late on these 3 projects? We hear about that from Idaho. We say, okay, we're gonna take that into our consideration of forward. I mean, is there that kind of communication, or do we isolate ourselves so that we don't know that somebody's got a bad reputation? It's not bad, but delayed reputation.
So ongoing, not really, but if somebody new, a new developer comes in, we will send they send us where they've done projects. And and then they sign off that we can ask those states how they, you know, if there are any issues with them, so we can check on new ones. But once they're here, we don't have an ongoing thing every year on who's late on this or that, but if the brand new do that.
It's a great service for the association, just to have an ongoing spreadsheet publicly available. Here's who's not meeting with deadlines, say, put in their own proposal. Yeah, that's fine, there may be legitimate reasons for it, but yeah, I think that'd be a cool ongoing process as well.
Nathan, is this all public information available?
Well, I mean, as far as everyone having a right to it, yeah, I mean, to the extent people are receiving federal dollars and public monies, and then all the data that they are. Okay, right, public right.
We do the same thing, like we get letters from other housing finance agencies, so and so developer has applied. Can you provide a letter, and we do that for some business.
We have them sign, at application stage, they have to sign, they saying that it's okay for us to go ask, and we can send that with, so they can sign.
Good. Thanks.
Alex, did you have something?
Yeah, you guys should tell me. I'm gonna be quiet. There is a section in QAP that may kind of related to this, but it's kind of lost its teeth. It's the cumulative credit section. It talks about how many credits any one developer can have under their control.
Yep.
For projects that are in, and the number's high enough now that it. The stretching and fine, but if you wanted to apply some pressures, brought that number down. And I think. If I was a board member, the marker that I'd be looking for starting construction. Because there's a lot of work that goes into getting to that point, but once it's under construction. Yes, we're motivated to go with the consultants out, but I'm highly motivated by construction interest, I'll tell you that. And so once that happens, you can feel pretty good about it. It's getting to that, so, that. I don't have the answer, I don't know what the number is, but that is already in there, and it's high enough now that we have almost 3 projects that haven't closed.
At the 8.5.
At the 8.5,
Yeah, I guess 30 million.
It's 30 million, so 8.5 times 3 is. Less than. Jason, that's the trigger, just new grants for this. It's
Placing service is set at 8609 now, so it ends at 6 months or so. Yeah.
So another tool that's in there that maybe back that up, I don't know. Think about that.
Was there any discussion about the cumulative credit you said
Last
to
year.
repeat this year?
We went from, no, we didn't discuss it. We went from last year at 24 million to like 30 million because we went from 6.5 to 8 million. And that's basically giving them 3 projects. One will be coming, comes off. They have to have it done in that 2 years anyway, so it kind of goes along with the calendar when they have to have one done, or sort of another one, so.
The board be comfortable if we kind of just itemize the cumulative credits as something we'll revisit for the 2028 QAP, and we'll kind of focus this year on kind of maintaining. Because again, we're hesitant as a staff to propose too many changes every single year, and sometimes it's helpful for predictability and stability to just kind of keep some things the status quo. Monitor it over the next year, have some more robust quarterly reporting and information sharing with the board, and then visit in 27.
I mean, I was thinking maybe input from.
Yeah.
But
Yeah.
I think you don't want to push that forward.
But we should put that on the list.
Yeah.
Okay, let's have that on the list for next year then.
What happened to the service?
Yeah, the median service. So at the max, it would be, 3 deals, 3 full deals if you did 8.5 on each one. That's why it was raised.
Really getting rid of this about there's capacity, what is there? They work in 12 states, and they work just in Montana.
It just seems like there's an insistence of money in it. Put some team, have an expectation, some movement. Here in the QAP, but we're gonna hold you to the time. Maybe over here on the cumulative, up to 30 million. Doesn't seem like you're really to the time. $30 million plate. So what's my problem? I'm still under the community to play. So what are you harping me in? Just because I'm the lake.
So we raised that similar percentage of when we were at 6.5, we were 24. So when it was 8.5, we raised it to 30, as it was the developers that asked for the 30.5. But percentage wise, it's still 3 full deals and a little change. So we kept that way and kept consistent for the years we had it at 6.5 and 24 as well. So that's why it's changed.
It's not, it's closer to
But the 6.5 and 24, so if we went to 8.5, we went to 30, so percentage wise, it's similar.
But I don't know what methodology you use. My thing was, they think you often pretty big number. Dollars, but several projects, not even the case for service. And if the intent we've been discussing today is to try to put a title of ribbon specs and delivery. I think, on one hand, we're saying we want to deliver the project, just like you said you. On the other hand, we're building a pretty good playground to make an argument that, hey, we're still good. I'm still within your own QAP guidelines.
So instead of a number, is there a number of, would it be better to say how many projects, I mean, how many projects do you think they should have out there? 2 or 3? Because right now they could have 3. So should they limit it to 2? I mean, we limited per year at 8.5 already. So we're really talking about, is 2 the right number or is 3 projects the right number to have out there?
I just think it's a more complicated conversation because if there's 2 people in Don's office and there's 20 people doing development in somebody else's office. Massive place in, right? So they're all small shops, so it's pretty even test, but I think it's a more complicated conversation than they need to say for today on the fly. But definitely we should talk through it for next year's.
Agreed. I think we want to have a broad group of developer stakeholders at the table for this conversation. To change.
Should just make it so, let's live with it. Can't get right. I mean, that's pretty simple, right? That's your report. Hold on.
All right, well,
State legislature, one point, trying to make it out, it said, the loans made on trade, it has to be solution.
I know the laws.
Tom Hannah was.
Montana's gonna get credit. so.
okay, last call for questions or comments on the QAP. Jason, do you have anything else to add?
I don't. Thanks, Mark, for joining us.
Yeah.
Yeah, thank you.
And then just the timeline going forward?
Timeline, so public comment period is over this Friday. And then we will be bringing this for board approval in the November meeting.
Then after the board approval, then it
Then it
goes
goes
to
to the
the
governor.
official, yeah,
And then it goes to another comment period.
the official arms process.
Yes.
Then it becomes effective.
Yep.
All right. So let's go ahead and pivot to our proposed calendar for 2026. I think that's next time. Isn't it? All right. So, board meetings, most board meetings are held the second Monday of the month, with a few exceptions. If there are conferences that conflict, and then the April and October, the board training and strategic planning is held on the Monday, board meeting the following Tuesday. All board meetings are proposed to start at 8:30 as they have been. January and February are both proposed as via Zoom on that second Monday. March is proposed as the 16th, and I believe that was because of the NCSHA legislative conference. It's also in March. I think it's the second week in March, so that's why we are proposing the third Monday. For April, strategic planning, I think that's the second Monday. Check. Yes, that is the second Monday and Tuesday. And I'll come back to the location options. We'll kind of discuss that at the end. For May, pre-application presentations using our new language of the proposed QAP instead of LOI. Proposing in person, Monday, May 11th at the Great Northern in Helena, and then Tuesday for the, invitations for full application. June and July, August, September, all proposed for the second Monday of those months, all via Zoom. The October meeting, we have to thread the needle between the Mountain Plains Regional Housing Summit that is going to be in Idaho the first week in October. And then we have our Housing Partnership Conference that I believe is the second week in October. Yeah, the Housing Partnership Conference, I'm sorry, that was in May. So October is the NCSHA annual conference. That's what I was missing. So we proposed the strategic planning training session on the 19th. And then the 9% LIHTC awards and the QAP on the 20th. For November, I listed the 9th or the 16th, and I'm trying to recall, I feel like the 9th. Oh, it's because the 10th, I believe, is Veterans Day. So we could meet the 16th, the third Monday instead, for those that may wanna take advantage of taking a Monday off to have a longer weekend. And then the December board meeting, just the standard second day. For conference and networking opportunities for board and staff, we have the NCSHA Legislative Conference, March 9th through the 11th, DC. We have the Mountain Plains Regional Housing Summit in Idaho, May 4th through 6th. The Montana Housing Partnership Conference, May 18th to the 20th in Fairmont Hot Springs. We haven't typically included the NCSHA Housing Credit Connect as a board opportunity, but it certainly could be. We do, they send a couple staff to the Housing Credit Connect. That's really MITech multifamily development focus. That's going to be in St. Louis, June 2nd through the 5th. And then the NCSHA Annual Conference is October 3rd through 6th in Detroit. So before I move to the location options, which is the funner part of this conversation, do board members have any questions or concerns about the proposed agenda? And what we would do is we would give you guys until the November board meeting to kind of mull it over, look at your schedules, get in touch with Gilbert and I with any kind of major conflicts or concerns. And then we would bring any modifications back to the board at the November meeting for a formal adoption of the 2026 schedule. All right, so for locations, and these are just suggestions from the staff, but we're here to take suggestions from the board as well. We do want to try to make sure that we get around the state a little bit. So we proposed Dillon, Miles City, Hardin, and Shelby as all possible locations for either the April or October meeting. We did talk at dinner last night around Hamilton. We haven't been to Hamilton in quite some time. I think we had a couple of other suggestions. But Livingston, that's right, Livingston.
We don't want.
So do board members have any particular preferences on where we get out next year? And we do try to invite local officials, elected officials to attend these to provide kind of a local perspectives on affordable housing needs. We did reach out to county commissioners and the mayor here, got a response back, reached back out, and then we didn't hear back. But that has been one of my goals with these traveling meetings, is to have an opportunity to hear from local communities. It's also helpful if we've had projects that had been previously funded or maybe getting close to breaking ground or being placed in service. Sometimes it's nice to co-locate a board meeting so we can visit a project. We saw the Bax block apartments at the very early stages, and now it looks fantastic. They're reopening. So I think those are fun things to see too. So suggestions of where we'd like to go for next year.
Well, since I spend half the flight on the road, I'd have them like you where we eat outside of Four Races.
Where at?
Pardon. Oh, pardon, there was a spot to eat.
Four Races. Good.
Yeah, Four Races served a pretty good habit. I just don't, I think they've got a subway shop. There's not a lot down there. So.
Okay.
I was at we had a meeting in Miles City years ago. When we took on the failed First Bank program, it was not a bad spot. So I have no issue with Miles City. I have no issue about, the only thing about doing Old Shelby.
Dylan, we've had a couple of projects recently, right? Jason? Dylan projects, yeah, so.
Yeah, well, just last year we did 9%. Yeah, so next year should be things.
It's fine.
Yeah, he wants that in the cross with the thing.
The Fishers did down there too.
Fishing.
All right, so any votes for Hamilton or Livingston? Any strong opinions?
I recall in Dillon because I've stayed at the Fair Bridge a few times when both my kids have gone and one's going here now, and I don't recall their conference room being very big. So it would be probably half the size of this, which might work for us.
They have a
In Dillon.
community college there. I wonder if there are spaces that could be.
And I could contact school there and see if we could use something at the Western. Yeah. So Dillon wouldn't be bad.
So if we do like a Dillon, do we want to do something a little further east for the other one? Do we consider Livingston east?
Oh, I don't think so. I think Livingston's fine, and Miles City's fine.
So maybe a Livingston or Miles City and then a Dillon or Hamilton? Does that sound like a good short list? And then maybe Logan can do some research on venues before we finalize this proposal and then we'll, you
Logan
guys-
Hamilton has the big route, River Inn is where you would want to check it out.
And for what it's worth, and not to cast any negative thoughts about the fine community here. As we do this, I think communicating with the city leadership, saying, hey, Will and Kendra, we really want you to show up for the meeting. Because housing is a big deal for all these communities.
Absolutely.
And, you know, they can't take an hour, half an hour of the day to come. That's, you know, we want them to talk to you.
Okay, so we'll run this up and if you board members could please review this list and check your schedules. If you have any, you know, trips to Europe planned or anything like that, if it's a major conflict, you know, surgery, you know, anything big, please, let Logan and I know so we can be thoughtful about, the schedule. And then, I got a correction, Julie Flynn reminded me that Veterans Day is November 11th. So I was wrong about that. Thank you, Julie. All right, well, any other matters to bring before us today? And if not, we can adjourn and then the board and staff chat about reconvening to head over to do our Hopper Underground tour. So should be pretty fun.
And
All right, Sheila or Rachel, anything online before we adjourn for the day?
No, thank you. That was a lot, so I took it all in.
Well, thank you
And
for
I'm
hanging in
sorry
and
that
being
I couldn't be there with you guys.
How you doing, Rachel?
I'm good. I'm hanging in there.
All right, well, we're all pulling for you, so
Thank
best
you.
wishes. And we really appreciate you joining virtually and to Sheila as well. It's probably like 4 a.m. in Japan now, so I think she. But thank you everyone online for joining. We're gonna go ahead and stop the meeting. We'll re-adjourn tomorrow for the board meeting at 8:30.
8:30.
Thank you.
All right, so what's our head count for?
Does everyone want to go?
We have 13 staff and we're one of the.
Yes.
So that's 14, 15.